Dividend investors, bonjour. Mike Yahoo here, founder of Dividend Stocks Rocks. Sorry, I'm just going to make sure that I have the, okay, so everything is good now. Don't worry, we're not going to start until 1 p.m. So we have like 2 minutes to chat. I just wanted to get the chat starting on your right side, sorry. And hello, Oza. Hello, Mia. You have the handouts that you can download. So it's the entire presentation. So it will be easier for you to follow. Hello, Scott, Vicky. I'm very excited today. We have over 1,600 people that registered. Obviously, not all people will go live, but I expect probably like, I don't know, like 300, 400 people live today, investors. So thank you for your time and for your trust. It's going to be fun. We have Vero that is in the chat here. She is going to take care of all your questions and your comments and so on. So, oh, Aaron, it sounds like Florida here in Quebec too, actually. We're like 30 degrees today. The pool has started, so it's a great afternoon. And after this webinar, I'm definitely going to have a dive there. So it's going to be fun. I'm also excited because the NHL playoffs are starting today for me as an AB fan. So I'm pretty sure I have a few hockey fans over here. Maybe a few Leaf fans, so don't worry, I'll still answer your questions today. Yes, God, go Leaf, Dave. Oh yeah, so probably that I have not enough AB fans here, but that's all right. Yeah, John. Well, you have a young team, so maybe the Senators will eventually be good. So I'm not too worried about it. They have given us a hard time this year, so nothing is lost for this one. All right, so just want to let you know, if you have to leave after the before the presentation is over, don't worry. There will be an automatic replay link sent to you this evening. The presentation is about 1 hour, and I'll stick around for another hour of Q&A, so that's super important. Nicola Abs for the win, Vero, there you go. So anyway, it's going to be a lot of fun tonight. That's for sure. It's going to be an interesting game. But now, today, we're not going to talk about that. We're going to talk about retirement and the withdrawal mechanics. Today, we're going to discuss three major themes. The first one is how to create a safe and reliable income, because this is what we're looking for if you're about to retire, or if you're retired already. The thing that you want to make sure is you don't want to suffer from any dividend cut or capital losses. So this is very important. Second point, we're going to look at how you can improve your existing yield. I am a dividend growth investor, and I focus on dividend yield and dividend growth. So obviously we're going to talk about lots of dividends today. And finally, how to protect your capital at retirement. So it's one thing to generate income, but it's another to make sure that this capital will last throughout your entire retirement plan, especially right now, because you have life expectancy of maybe like 85 or 90 or even 95. It's going to be crazy. I also be here for at least an hour, maybe an hour and a half, because I can see that we have a lot of attendees today. You can ask me all kind of questions about the stock market, about the US market, about stocks, ETF, financial planning. I was a financial planner and a private banker for over 10 years before I started working on Dividend Stocks Rocks. So I can give you all kind of answers, but I am not giving financial advice. I am not giving you buy or sell recommendation either. If you ever lose money after this webinar, I am not responsible for any of your loss, but on a good side of things, you won't have to pay me a dime if you're making money. Before we go to the Q&A, I will also invite you to join Dividend Stocks Rocks. This is my membership. I've put Last Chance over there because we have made major improvements over the past six months, and we keep investing on the platform. So this is the last time, if it's not your first rodeo with me on the webinar, this is your last time that you're going to get a great deal on this one. On June 1st, all prices at DSR increase. So this is why I wanted to give you a good 10 days to think about it. And let's start with this webinar. So all retirement starts with a budget and taxes, right? So the question isn't at what age you want to retire, but at what income. Unfortunately, I cannot discuss much taxes during the presentation. I'll be able to answer your question after that, though. The only thing is, Taxes are very sensible topic. You may be Canadian, you may be American or European. You may have a Lira account or a good pension plan or a corporation. So every advice is not good for everybody. So it's really a case-by-case scenario. And I would like my biggest advice on that. And yes, you can ask me questions, but honestly, go seek advice from a professional accountant, a tax expert. They dabble in that stuff all the time because those rules change all the time. And general advice is very poorly, is a poor idea. Most of the time, it will make a big difference if you take the time and you pay someone to go there. I'd say go with your investing strategy first and then go about tax optimization. The problem with that is a lot of people focus on taxes, which is also a good way to maximize your return. But the thing is, you don't want to sacrifice your total return or your retirement plan just for the sake of saving a few bucks that you won't have to pay for the government. So focus on your investment strategy first, and then you can optimize throughout different accounts and different strategies. And this is where you can make a good retirement plan. I personally like to combine all my portfolio accounts that have the same goal. So if I have a Lira account, RRSP, and a TFSA, for example, because I'm Canadian, well, I would combine all those accounts together to have my global sector allocation. And then it will be a lot easier for me after that to optimize for taxes, to optimize for when I will be withdrawing money. And this is how we're going to be able to get the best out of that hard-earned money. So the first topic today is how to create a safe and reliable income. So let's take the example, classic one. You need $60,000 a year, and how can you make it at retirement? So today we're going to discuss two ways of create a safe and reliable income. The first one is the dividend option, and the second one is the homemade dividend option. Is it all right for most people? Because I can see that there's some problem with the camera and the sound, so just want to make sure that everything is good. Yeah, so we are over like 400 people today, so I'm sorry. Sometimes technology, as people log in at the same time, be a little bit quiet, be a little bit patient with that. It should be good as most people finally register. As I said, there will be a replay. If there's any problem, I can even post it on YouTube with closed caption, so you don't have to worry about that part. You'll get all the entire webinar at the same time. All right, so let's go with the first option, the dividend option, which is relatively simple. So you need $60,000. You just have to generate 6% yield on a $1 million portfolio. So we would all wish we could have that $1 million portfolio. And then the question is, can I generate a 6% yield? So the pros of this strategy is quite obvious. So it's simple and straightforward, and our brains likes that. It's easy to calculate. You just have to select the company according to a stock screener. You go after like those great yielders, and then you feel good about it. I'd say that it works perfectly if your portfolio is large enough to generate about 4 to 5% yield on it. And I'm talking about current yield and not yield on cost, obviously. But if you try to reach up to 6%, you may have some difficulties going further. You may experience dividend cuts. You may experience lack of dividend growth, meaning that the revenue that you get today, that $60,000, will keep up, same thing going forward. And this could be a problem. Not today, and we're going to talk about inflation a lot later on today, but that's a big problem, because at one point, if you have a 2-3% inflation in 10-20 years, that $60,000 will not be worth enough. The other cons, on the other bad part of it is it requires a lot of capital, unless you're willing to go at like 700K and try to generate like at 9-10% yield. But then again, you're going to have some surprises. I want to start by telling you to be very cautious when you look at easy solutions, those that are built in for you for income. I've pulled two options here. So the first one is Canoe Income Fund. Known for its generous yield and pretty much good performance overall. We're going to see that in a minute. So it's not the worst case scenario. But if you go with this one for income, look at the chart from 2012 to today. So for 9 years, you will not get a single increase. So at one point, inflation is going to kick in. The worst case scenario could happen if you go with companies that will do like some kind of like split shares. Split shares, again, very popular among retirees because they show like a 9, 10, 12% yield. But as you see with this one, the Financial 15 Split Corp, it cut its dividend. It lost in value. So one day you realize that you have not only you're under for your monthly budget, but you're also under in terms of capital. So you cannot turn around and buy something else and generate the same yield. That's a big problem. And when you look at how split shares are created, they will likely put 15-20% of of their funds and then to buy those high quality blue chips. So they will tell you, if you go on Quadravest website, they're going to tell you, oh, we invest in Enbridge or in Bell or Telus or Canadian banks or Sun Life, all great companies that are known for their stability. That's great. The thing is, 80% of their money is not going into those stocks, but rather in kind of like a black box where they play around with options. So you will have like covered calls, you will have put options and then trades on those. And this is where when everybody's happy and the market goes up, you won't feel it. But then when the market goes down and margin calls are applied and stuff like that, well, there you go. You have a dividend cut and then you suffer greatly. So you don't want to put your retirement at risk. You don't necessarily want to go there at the same time. Now, back to Canoe Income Fund. If you go on their website, they show great returns. So what I've put in red here is each time the fund has beat the TSX. I kind of find it funny because you can see that the fund has beat the TSX for the past 10 years and since inception. Not by a wide margin, but still pretty good. But then when you go at their asset allocation, you realize that 50% of their funds are not invested in Canadian equity. So comparing yourself to the Canadian equity, but having 50% into the US stock market and foreign equity to boost your return is kind of not necessarily super honest, in my opinion. And if we look at the combination of the Canadian equity and the US equity, you'll see that obviously the S&P 500 and the Vanguard Dividend Appreciation ETF generated 170% and 142%. So it's a lot more than the Canoe Fund at 115. So technically, you should have like 50% from that 170, another 50% from the 85% that was generated from the TSX. You get that average, and it's probably a lot higher than the 115. So you're leaving a lot of money on the table. You have to be very careful about that. I have also put in comparison the Financial Split 15, which is at the bottom of the list, 48% return between 2014 and 2021. Not a bad return, but when you're thinking about how it has not been that successful recently, again, you can put your retirement at risk big time. Another products I want to discuss today before we go with the other options is covered call ETF. They're very popular because they do the job. They generate income and they're relatively stable. The most popular one in Canada is definitely the BMO Covered Call Canadian Banks ETF. So this one is only writing covered calls to increase the income and have a higher yield than Canadian banks. And at the same time, the underlying assets, I mean, the top 6 Canadian banks are just amazing. They work in an oligopoly. They are generous with their yield. generous with their dividend growth when regulators permits it, obviously. So it sounds like a very good product, but when you look at it, unless you invested, you would have invested most of your money in Scotiabank over the past 10 years. All the other banks have outperformed the covered call by almost 100% and more. So that's a lot of money that you leave on the table once again. This could permit you to stay longer in your house, to have a nurse that goes at home and take care of you, or to modify your property using elevators and stuff like that to stay at home longer, or have better care, or move to a better place. All of that would be possible if you decide to put your money into Canadian banks instead of going with the covered call on Canadian banks. So that makes a huge difference. Interesting story here. A lot of investors will tell me, yeah, but Mike, that's because you're not used to invest in high yield stocks. I can build my portfolio generating 7, 8, 9% yield and I'll be just fine. And I had this discussion back in 2014 with some of my readers, and that investor was actually an experienced investor. He knew what he was talking about. He was very comfortable and very knowledgeable, and he has been done that for several years. So throughout my discussion, I asked him to propose like 4 favorite high yield stocks back then. So the first one was Starwood Property, the second one was Ares Capital Corp, and the third one was Kinder Morgan. So you can see those on the graph. Good news. Starwood and Ares almost did the same thing as the Vanguard Dividend ETF appreciation. So pretty much on the same level in terms of return. So that's great. So you enjoy a strong yield, but on top of that, you're not leaving money on the table. Now it gets a little bit worse when you look at Kinder Morgan, whose total return is down by 35% since the day that he submit the stock picks. The last company was Brave Burns Partners. It was MLPs, so in the pipeline business, and the company went bankrupt. So this is why it's not on the chart. So it's not only cut their dividend completely, but unfortunately went bankrupt as well. So all that to show you that out of like 4 great company where an investor that knows what he's doing and he did his research and he actually offered those as their top picks back in 2014, only 2 of them were good enough to maintain a good income and not making you losing money or leaving money on the table. So if you combine the 4 of them, you are definitely in deep problems. Another way that a lot of investors look at dividend is to try to manage both their needs along with the distribution. So they have monthly distribution or dividend cycle. So the companies that will pay their dividend in January, April, July, and October. Honestly, I don't think you should try to combine your and buy stocks that will just work with either just monthly distribution or dividend cycles. You just limit yourself too much for nothing, and you just reduce your exposure to maybe better stocks. And if most of them would be following the January, April, July, and October cycle, maybe you should do that and have a small cash reserve just to wait for the other 2 months where you get less income, but you have a better portfolio. So then again, a little bit like taxes, don't focus on the distribution, but focus on the total return and get the maximum in terms of the investing strategy, instead of having something that is, yes, super easy. You just say, oh, I need $4,000 of income per month, so I'm just going to make sure that my company pays that $4,000 every single month. It's very easy, but in reality, you're just hurting your portfolio and your strategy to move forward. Bonnie, you said, what do you mean don't calculate the yield on cost? What I was talking about is if you have $1 million today and you need to generate 6% of yield, you're talking about the current yield, so not based on the cost of purchase. So maybe at the beginning you had like $600,000 where you bought all your stocks, and now it's worth $1 million, and then the dividend growth increased big time, and now if you look at your yield on cost and you generate $60,000 a year, $60,000 on $600,000, it's 10% yield, but that's your yield on cost. which is a good metric if you want to look at how your dividend stocks have performed in the past in terms of dividend growth and so on. But it's not helping you in terms of managing your budget at retirement. You have to use the current yield, because that $1 million you have, you can either generate 5%, 4%, 6%, depending on where you invest it. But this is the money you need. This is the money you have, and this is how you can generate income from it. One thing that is super important, dividends aren't magical. I know most of you know that, but sometimes we tend to forget. So I wanted to point that out with a real life example. I've looked at when Royal Bank had this record date, and you can see that the stock price decreased right on April 22nd. If you compare those to other banks at the same day, you can see that the red line, again, Royal Bank, the stock price decreased, not exactly by the same amount of the dividend payment, obviously, but at least enough to show you that once the company takes its money and send it to your account, then it goes down at the same level, because the company doesn't have that money in its bank account, and now it loses value. So that brings me back to the second way that you can create your income, and it's creating your homemade dividends. So let me ask you, would you prefer to invest in Alimentation Couche-Tard with a yield of 0.86, not even 1%, or Canadian Utilities at 5% yield if you are retired? I'd like to have a few comments in this in the chat here. So tell me, Couche-Tard or Canadian Utilities, you're about to retire or you retire now, which yield do you prefer? Which company you prefer? So some ATDs, some Canadian Utilities, probably more Canadian Utilities I can see. Some comes with an interesting answer with half on one, half on the others. Now, let me show you what it looks like over the past 10 years. Look at the graph here. You see the total return. So you have Alimentation Couche-Tard generating almost 1,000% growth, and Canadian Utilities total return. So that includes that 5% juicy yield of 86%. And I'm not saying that Canadian Utilities is a bad pick. It's actually a very good pick. It brings stability, and you can see that the total return graph is a lot more stable for Canadian Utilities than for Alimentation Couche-Tard, that it goes up and then it plateaus and it goes down and it goes up. So obviously that there's that fluctuation. But what I want to highlight here is to show you the difference between a company that will give you the money right away and a company that say, hey, you know what? I'm going to keep that money and I'm going to make you richer down the road. So I'm going to use it to make acquisition. I'm going to use it to invest in marketing and restore and renovate our convenience stores and to bring more growth. So just want to show you the difference on both. And then actually, the answer that I've loved the most was actually having a part of my money into Couche-Tard and the other part into Canadian Utilities, so you can benefit from the stability and the high income, because it makes you feel good, right? Obviously, so every quarter you get your high yield, so that's great. But then, if you can have a little bit more growth, at one point you can sell a few shares. So the homemade dividend will focus a little bit more about dividend growers and will ignore the yield. So usually you will have a portfolio that may generate 2, 3, maximum 4%. If you really focus on dividend growth, it will probably be more between 2 and 3%. And what you can do is to look at having a cash reserve of 18 to 24 months if you're looking at a 2% yield, or slightly lower, so 6 to 12 months if you have a 3-4% yield, assuming that you need about 4% yield from your retirement portfolio to live the life that you wanted. The key here is to stop dripping and to add future dividend to the cash reserve. So basically, the reason why I'm telling you this is, let's say, as I mentioned earlier, Alimentation Couche-Tard will go up and down all the time. So it's very difficult to say, oh, is it a good time or not? So you don't want to get caught trying to withdraw money from your portfolio in March of 2020 or even in April of 2020, right? When the market is down 35%, you may want to be able to wait a little bit. And this is what having this cash reserve will be able to give you. Obviously, if you sleep well at night and you feel comfortable with the market, you can definitely go with 6 to 12 months, smaller cash reserve, and then you get your dividend and then you're doing okay. But the 2 years period is a lot more to say, well, that covers for most of bear markets. So whenever the market goes down by more than 20%, on average, not all the time, on average, it will take about 2 years to recover. Sometimes we're lucky, like last year, so we recovered super quick. And some other time, when we think about the tech bubble in the 1999, 2020, it took 2000, I mean, it took about 5 to 6 years to fully recover. But if you skip the worst part, then it will be still easier for you to just wait and start selling shares after 1 year or 2 years down the road after the most biggest part of the bear market is over. At this point, you look at your portfolio and now you wonder, okay, I have to sell shares because the dividend is not enough. So which one could I use? First thing I would say, identify your overweight stocks. So, and that limit is personal to everybody. I've decided that my limit for exposure for a single stock is 15%. I had to have this discussion with myself because I had purchased Apple back in 2014. And at one point it grew so big. It's like over 600% return, close to 700% return in my portfolio. So obviously at one point it went over 15% of my total portfolio. I told you I was a financial planner back then. I had one client before 2008 that was working at GE, General Electric, and he had a huge chunk of GE shares. And I was telling him, like, you know what? Half of your net worth is in a single stock. But back then, I mean, between 2000 and 2007, GE stock was doing well, pays a dividend, well diversified, plenty of business segments, doing business across the world. It was just an amazing business, right? But the thing is, as you know, 2008 happened. The company went into a lot of trouble, too big to be managed, dividend got cut, and this poor client saw his net worth melting down like ice cream over the sun. And that is too bad. So this is why it is important to put yourself your own limit. Brian, you're asking 15% of the dollar amount? Yes. So I was looking at my portfolio, and at one point, Apple was 17% of my total portfolio. So all portfolio combined together. So I start trimming a little bit to make sure that I'm still well diversified, especially once you're retired, because yes, if you retire around like 60, 65, chances are you have 20, 25 years in front of you. So a couple of like economic cycles, ups and downs, but still you have less time to recover. So you don't want to get caught in the middle and then suffer from a 40% loss on a single stock. Second part, I would get rid of my weaker ratings. So at Dsr, we rate all our stocks from 1 to 5. So it's very easy to understand. And I think that any investor should do that, either from 1 to 5 or from 1 to 10, but rate your stocks. And we use 2 different types of ratings. First one is a classic from sell to buy, so 1 to 5. And then the second one is to give a dividend safety score. So how safe is the dividend? Will the dividend increase moving forward? And the combination of both ratings will obviously identify very strong stocks and very weak ones. And this is where I would start selling shares of this one, because unfortunately, at the time that you bought those shares, maybe the company was doing great, but a few years down the line, maybe the environment changed, maybe the business model changed, maybe new competition appeared. You need to take care of that and get rid of your weaker ratings. Focus on sector allocation when you look at your returns and your yield. Most of it will be generated and explained by how you have invested your money. So when you're about to sell shares, it's a good way to just say, okay, so I'm a little bit overexposed in utilities. I'm going to trim that a little bit and generate my income from it and move on going forward. I would not do more than I would not do transaction more than once or twice a year. Obviously, first, to avoid transaction fees, and second, to avoid trying to time the market and be always active. And let's be honest, you've worked all your life to get that money invested. Let it work and let you enjoy your retirement instead of always looking at your computer and wondering if it's the right time to sell or to buy. You can do that like once or twice a year. It will be more than enough. And this also explains the peace of mind that having a cash reserve will bring to you. Yeah, Greg, being able to sleep at night is important. It's actually, you know what? No matter what is the investing strategy that you use, the best investing strategy is the one that helps you sleep well at night, regardless of what is putting on your portfolio and your total return. If you don't sleep well at night, if you're not comfortable, this is where things could go wrong. So to summarize this first part of the webinar, how to create income summary, beware of high yield products. They are very generous, but they cost a lot, and you can make sure that those investment firms, they make money a lot on those products because they know there's a high demand. And for that problem, there's a lot of solutions, but they will make a lot of money on your back as well. Dividends are as good as capital gains. A healthy balance between both could do a long way. And having a good cash reserve will obviously reduce the amount of stress. Now, second part, how can you improve your yield? I've discussed it a little bit before. Focus on your sector allocation. If you invest most of your money into REITs, utilities, financial services, you can add a few telecoms, pipelines, and healthcare, then obviously you'll be able to get a 4% yield on your portfolio. It will be healthy, well diversified, and you will still be able to have a few percent of dividend increase every single year. That will help you to protect your portfolio against inflation, but we're going to talk about that later. I've put a few tickers belongs each of them. I will let you, since we have a huge presentation, I will let you sing that in. You have the presentation. You can download it in your handouts if you just subscribe, if you just came in and you're a bit late in the presentation. So you go into handouts, you can download the presentation. You'll have all those tickers. It's just a path to reflection, a few ideas that you can dive further. All of them will generate more than 3%. Most of them is over 4%. I still had the Canadian banks, Royal Bank and National Bank are closer to 3% yield right now, but they're worth it. They are definitely worth it in terms of total return. The others, they will be able to generate good income and protect for inflation at the same time. I wanted to give you an example of what it looks like. This is the asset allocation per sector that we have for our retirement portfolio at DSR. That's the Canadian portfolio. Just to give you an idea, as you can see, 60% of our portfolio was invested in utilities, real estate, and financial services. That portfolio generates a yield around 4%, but what's even more interesting is that it beats its benchmark, which is the XDV. It's a dividend ETF, dividend growth ETF. So it did better than the benchmark. It averaged a very good returns, but yet you can still focus on that yield, getting that 4% all the time. That is going to help you retire happily. Another thing you can do is you can start with your portfolio and then start looking at better options. What you see here is a part of my own personal portfolio. You can see, and I've obviously selected the ones that has the lower yield possible. So we have companies like Visa, Apple, Texas, Alimentation Couche-Tard, Microsoft, all companies paying under 1% yield. So will not necessarily be good if you focus on of income. So what I'm going to do now is I'm going to share my screen. This one, there you go. So now you have my screen. And what I've done is This is the stock screener that we have at DSR. I'm just going to give you an idea of how you can optimize your portfolio with a higher yield by selecting companies in the same sector. So we're going to use the filter right here. So let's say I want to replace my shares of Apple, which may not necessarily be a good idea, but for the sake of the example, I want to increase my yield. So I'm going to select the US market. I'm going to select technology sector, and obviously I want a pro rating at least of 3 here and a dividend safety score of at least 3, and obviously yield at least of 3 as well. So when we do that, we have only 3 stocks that are potential here. Obviously, we're talking about the technology sector. They're not known for being generous in terms of yield, and that's fine. But you can see that you have a very interesting pick here, which is Broadcom. The dividend yield's at 3.16 right here, so it's pretty good. But the pro ratings are amazing. There's also Hewlett Packard and Juniper Networks, but pro rating and dividend safety score at 3, not that great. So if you go here, and then you can decide if you like this company or not. You have the summary of the company, you have the pro ratings, you have the business model, more stats about the sector and the beta to see if it's going to fluctuate a lot or not too much. The later quarterly information, so what the CEO said and what we think about that quarter, our investment thesis to summarize why you should have this company in your portfolio or why you should not. The dividend triangle showing the revenue growing, earnings per share, which is more hectic. So we need to see what's going on here, dig a little bit deeper probably. And then the dividend trend, which is amazing. We can have the cash flow that is great as well, potential risk that we need to consider. That's obviously debt to equity ratio, financial debt, so some debts ratio here. And finally, the dividend growth perspective, telling you what to expect in the future, what the payout ratio looks like. You can see here that the payout ratio here is disgusting, but the cash payout ratio is very good. So the explanation will be explained here. So this is caused by multiple charges related to acquisition and other events. This is why payout ratio based on earnings, it's general accounting principles. So it's not necessarily cash in your bank account. Sometimes it could mix the possibilities. And we end up with the valuation section where we use the dividend discount model and also P ratio and forward P ratio as well. So now back to my screen here and the presentation, obviously. There you go. So this is how you can use, that's our system, but you can definitely use another type of stock screener, but just want to show you how you can go from a low yielding stocks to a better yielding stocks without increasing your risk. So you take the same sector, you do a little bit more research on it, and you try to focus on good ratings to help you out. So, and the ratings, obviously, they include the revenue growth, the earnings growth, the cash flow, the debt level, the overall business growth vectors, potential threats, etc. So it's really not something that is just a mathematic formula. It's really done by our analysts at DSR to give a good appreciation of a stock. So to summarize here, don't go overkill with 7% yield and up. This will just put your portfolio in jeopardy. Instead, you can focus on more generous income, more generous sectors. As I mentioned earlier, you can have a very strong base using utilities, REITs, financial services, pipelines, some telecoms. Maybe we're going to have a few questions about AT&T mega merger deal with Discovery. So they're welcome as well if you wonder what's going to happen there. At the end of the webinar, I'll have more than an hour to do that Q&A. So you have several sectors that you can play with. You don't need all of them in your portfolio anyways. So obviously a smaller portion into consumer cyclical or consumer or the tech sector will still be a good portfolio, especially if you focus a little bit more on yield. And finally, you can change your low yielding stocks in your portfolio to better paying yield and still have some kind of a good balance between the risk of having high yielding stocks in your portfolio and the fact that you used to have a very low yield, high growth type of company in your portfolio. Now, third theme today, how can you protect your portfolio? And we are going to look at three things. You want to protect your portfolio against inflation, against dividend cuts, and obviously capital depreciation, because you certainly don't want to put your retirement at risk. Let me ask you in the comment, I would like to know, what is the best protection against inflation in terms of asset classes, in terms of companies? How can you protect your portfolio against inflation? So Joe, you say stock, dividend growth. Stocks again from Sarah, Sana, Louis, dividend growth. Oh yes, I have a lot of dividend growers. Oh, tips, interesting. So treasury bonds that are adjusted for inflation with good asset allocation, cryptocurrencies. I'm very surprised. Real estate, very good. I'm very surprised nobody answered gold. I was convinced. There you go, gold. There you go. Okay, now let's take a look. It's kind of funny because before I started to make research a while ago, I thought, well, gold is pretty much the ultimate protection against inflation. Because when you go back 5,000 years ago, an ounce of gold or an ounce of silver was pretty much enough to buy yourself a nice dress for a ceremony. Today, an ounce of gold is close to $2,000, which is pretty much the price for a good Hugo Boss suits. So when you think about it, it follows the inflation, protect your purchase powers, but in reality, this is not exactly what's happening. And I see tulip bulbs. I will not comment on that, but some assets could look like a tulip bulbs actually. Inflation protection, that was done by Morningstar, an article that was written not too long ago by a CFA, and I was very surprised because in the 70s, basically the analyst looked at all the high inflation periods. So in the 70s, in the 80s, we all know that recently we have not gone through a high period of inflation. We have like 2 months of 3-4% yield of inflation right now, and everybody's panicking. But over the past 20 years, inflation has been non-existent. What you see is back in the 70s, during the stagflation, gold was the ultimate place to be. However, the last two episodes of high inflation, gold done a terrible job. Actually, it went down, and it costs you money to have gold in your portfolio. So not exactly the best edge. When we look at stocks, it goes up, it goes down. It's not too clear. It's a good edge against inflation, but we can see it's not perfect. The best one is probably Reits. When you look at Reits, and when you think about it, totally makes sense. You own properties, regardless if it's offices, retail malls, apartments, industrial facilities. You suffer from inflation in terms of cost of eating or whatever, and then you just like, hey, dude, let's look at the escalator contract that we have where rents goes up and up and up every single time. So they basically pass the inflation along to their tenants. So this is where at each time in the high inflation period, REITs have been a great winner. And obviously commodities is also a very good protection because it often starts from there. Right now we have the oil and gas energy sector is booming right now for the past 6 months after a very difficult year in 2020. So fuel increase, transportation increase, cost of raw materials increase in goods, and there you go, you have more inflation because there's a higher demand, higher cost for commodities, and higher cost of goods sold at this point. The downside of using commodities is you have to be ready for a roller coaster ride all the time, which is not necessarily the best thing if you're retired and you want to just sleep well at night and enjoy your retirement. The ultimate protection, in my opinion, is dividend growers and initiators. You can see here we're starting from the stagflation period up to 2019. Dividend growers and initiators outperform pretty much any type of other stocks. The point here is obviously if you have a company that increased their dividend by 3, 4, 5% every single year, you don't even have to consider inflation because inflation will be covered by your dividend payment all the time. Even better than that, the company that is able to grow its dividend, it's not the end that is important, but why the company is able to grow their dividend. Because they have a robust balance sheet, because they have a thriving business, because they are a leader in their market, or they have strong market shares, or amazing brand recognition, or well diversified. And all of those reasons that makes them able to increase their dividend year after year. And overall, when you look at research, dividend growers tend to not only outperform the market, but do it with less volatility, which is kind of amazing when you think about it, because it means more money in your pocket with less stress. So if you want to protect your portfolio at retirement, just don't go for the yield, but aim for a minimum of dividend growth. Even if it's 2-3%. For REITs, sometimes it will be enough, but it will be enough to make sure that the business is doing well, and at the same time that your portfolio is well protected. Now, if you want to go one step further and protect your capital on top of it, you must have a more solid base in your analysis. At DSR, we start by using what I call the Dividend Triangle. You're not going to find that on Google or anything. It's not a financial concept. It's pretty much a way that we have created DSR to make things easier and simple to understand. The Dividend Triangle has obviously 3 metrics that we look that creates that foundation. So we're looking at revenue trends, earnings trends, and dividend growth trends. So we can see here Fortis revenues growing 36%, earnings by 26%, and dividend growth by 35%. Pretty stable, pretty in line. That's kind of like a great, almost perfect dividend triangle. We would like to see a little bit more growth towards the end, like 2021. Obviously, the COVID hit, the pandemic was there, so revenue and earnings were not growing as fast as before. But you have a company here that has increased its dividend for like, what, 47 years, if I remember correctly. One of the most solid company in Canada ever. But when you look about it, is you want a company that grow their revenue because you want a company that is able to find growth vectors and that will thrive in the future and that has enough reserve to go through a recession. On top of revenue growth, you also want to make sure that this company is generating profit, because it's one thing to make sales, it's another to have a good, healthy margin and generate cash flow. And this comes with profit. So earnings, super important. And the combination of growing revenue and growing earnings should eventually lead to growing dividend. A company like this may not necessarily outperform the market, may not necessarily be the next Tesla or the next Apple on the stock market, but it will bring you peace of mind and it will protect your capital, because a company like Fortis is not likely to drop by 50% overnight. It will bring more stability in your portfolio as well. So in summary, commodities, REITs, and dividend growers work well against inflation. However, commodities are a bit too much fluctuating here. Personally, I'm not a big fan of basic materials and energy sector as a dividend growers, because their business model depends on the price of the commodity. When it's going high, cash flow comes in and then they pay dividend. When it's running dry, they have to cut their dividend and creates catastrophic situation. I'm thinking about Vermilion Energy. Ticker is VET. I'm just going to put it here so you want to take a look. It trades on both markets, so Canadian, US. This company doubled its price over the past 6 months, so which sounds amazing. But if you look at the past 5 years, the total return is like minus 80% right now. They cut their dividend, their price plummeted, and this is what you want to avoid as a retiree. And this is why commodities, I'm not too keen about it. Probably besides pipelines, are pretty much the only place that I would consider having a little bit more for income purposes. So REITs, dividend growers, definitely there. Dividend growth, more money equal less stress. And if you have a good dividend safety score, you will be able to avoid your dividend cut. So look at your portfolio, determine what is a 1, what is a 5, or what is a 1, what is a 10, or use DSR and look at how they are rated. And then if a company has not increased its dividend over the past 5, 6, 7 quarters, it should have a dividend safety score of 2. It doesn't mean that it will cut its dividend, but when you think about it, just with inflation, your dividend payment is being reduced every single year by at least 2%. So when you think about that, it's not that great. And when you think about the inflation rate that is communicated by central banks, they take a basket of goods, but I don't know about you, but when I go to the grocery stores, and I have 3 kids and a wife, so we're like 5 in the family, 2 teenagers, so that eat a lot. I feel the inflation a lot more than 2, 3, even 4% right now in April. It sounds a lot more when I go to the grocery store. So you have to consider that as well. As a retiree, you may not change your car, change your computer, and change your house every single year. So even though those places, maybe the inflation is under control, if you go to a restaurant, if you do activities, if you travel, you obviously eat. Those will be a higher cost of inflation than the basket itself. Finally, looking at a strong dividend triangle for picking up your stocks will reduce your volatility in your portfolio and protect you from massive capital losses. If you focus on yield, it will make you happy for a while. Especially right now. Right now, the market is doing well. You don't feel it that much. And you know, I like to say everybody looks good on prom night. When the market crashes, you realize that the wave was bringing all the trash from the bottom of the ocean. And when it goes down to the shore, now you can differentiate the bottle of water from the fish, and that's what you want to be. So you don't want to make sure you don't want to suffer from those dividend cuts, and you want to make sure that you have a minimum of dividend growth. I've seen several companies in the past that has no dividend growth for 1 year, 2 years, 3 years, and what you see at that point is whenever they hit a bump road, whether it's a market event, economic recession, or just a sector crisis, because it could be just for this sector only, they cut their dividend. The dividend cut leads to capital losses, and then you cannot turn back to go anywhere else. If you go for made for you products, they are expensive, and some of them don't work at all. So Canoe Fund, what we see is okay. Covered Call Etf is okay as well, but they're very expensive compared to what you could have generated from your portfolio. But if you go with other types of sources, at one point you may suffer from dividend cuts anyway, and then you have a big problem. You don't want to go through another 2020. If I would have done this webinar 5 years ago, I would have told you, you don't want to go through another 2008, 2009 financial crisis or a tech bubble. It's going to happen again. And if you're not prepared for that, because in the next 10 years, in the next 15, 20 years that you have for retirement, the economic cycle will happen again. You'll have recession, you'll have market crash, you'll have bear markets. And if you're not prepared, your retirement plan is in jeopardy. And it would hurt me so much to know that you thought that you were feeling good with that 7% yield and that you were safe. It's not the case. I've seen that several times as a financial planner, and I've seen that as in Dsr as well, because we do summary for portfolios for our Dsr Pro members, and sometimes we're just like high sector concentration or a lot of companies that has a high yield and a very low ratings, and eventually they cut their dividend or they lose money on the stock market, and then the entire world will be spinning out. So now, just before we go to the Q&A session, while stick around for a good hour, I just want to show you how DSR can help you achieve your retirement goal. Not too long ago, John sent me that email, and it's kind of funny because sometimes people, they look at me just like, yeah, dude, you're too young to consider a high yielding portfolio for retirement. This is what I'm looking for. Well, you know what? Most of our members at DSR are retirees. They are like 55 and up. And John was telling me DSR is especially relevant for retirees because we help them identify companies with stellar metrics and safer dividend. And that combined together will make sure that your portfolio can go through pretty much all kind of recession and troubles. Another point that is super important, Pat, that joined in December of 2020, he decided to let go his advisor and then save a lot of money on MERs. But more importantly, he got a lot of knowledge. We're not just here to get a bunch of tools. So we do have portfolio models. We do have the stock screener and stock analysis, as I showed you. But most importantly, we do private webinars. Last year, when the market crashes, between March and April, I did 5 private webinars, so pretty much one every single week. Just Q&As, answering questions to my members, making sure that they feel comfortable and that they can continue to invest with conviction, because that's what DSR is about. Help you invest with conviction and retire happy. Obviously, our tools are amazing. We are back now for all our financial metrics by Refinitiv Icons. Refinitiv Icons is a professional trader, what's the name, terminal. It's owned by the London Stock Exchange. It used to belongs to Thomson Reuters. So it's like high-tech, very powerful and very accurate data. And we want to make sure that you get access to this information all the time. So obviously you don't have access to the Refinitiv terminal, but you do have it with all the stock screener and everything that you can do. So now I'm going to unlock the offer. It is the last chance that you have to subscribe at this low price. We have invested a lot in our platform over the past 6 months, and we are investing a lot more going forward. Those who are, it's not your first webinar, you know, I've done that for the past 3 years. This offer, $97 for the regular membership, $197 for the pro membership. This is a lifetime discount. It's never going to increase, but going forward on June 1st, we increase all prices on our website, and this promotion will never happen again. Regardless, if we increase prices, yes, we can play with the coupons, but the coupon codes will never give you that low price. I'm going to show you what it looks like when you click on the portfolio, not a portfolio, but the offer. So here you're going to get the information about DSR. You can scroll down, you can download our free recession workbook to see how we use DSR and how it's working inside. It's a great workbook, 35 pages PDF, to help you establish your sector allocation, understand how to manage your buy process and manage it along the way. It has helped thousands of investors so far, so I'm very proud about it. So you'll have more information about how you can rethink your portfolio, pick the right stocks. You do have 60 days money back guarantee. My goal is not to take money away from you. So if you're not happy with DSR, if it doesn't fit your investing strategy or whatever reason, you don't have to worry. You send us an email within 24 hours, we reply back. Usually it's more within 4 business hours, to be honest. We're very fast on emails. And then boom, you get your money back right away. No question asked, that's for sure. Once you want to reach out the deal, so you can click on all the buttons saying, I want to join the DSR community, or on the top here, right there, I want to join DSR, give me the discount. And you will have the 2 options. So the pro options with the coupon code Retire Pro, and the yearly membership with the coupon code RETIRE. So you click here, you're going to have a pop-up like this, and you enter the Retire Pro or Retire coupon code. The price will stay the same on your left to show you the value, but it will never be that price. You will pay $197 a year forever. If you prefer to buy in US dollars, well, there you go. You have a US dollar subscription. The subscriptions give you access to the same content, regardless if you're American or if you pay in Canadian dollars. I do that just because I'm Canadian and I know how it sucks to pay in US dollars these days. So this is why I am offering you both options. So right here, sorry, presentation. They changed the... there you go, it's right here. Sorry about that, about the delay. They changed the layout like last week, so I'm not used to the new layout on my webinar platform, that's for sure. So three things that you can do to get immediate value once you subscribe. The first one, you can go online and create your portfolio. You can create as many portfolio as you want. You'll be able to look at your sector allocation and you'll be able to improve your ratings. So that's great. And actually, I'm going to show you how it's done. It's very easy. It's going to take you a few minutes right here. So you go in my portfolio right there. And in the portfolio, you can add plenty of stocks. So we cover about 1,000 stocks. So if it's any company that is covered in our portfolio, let's say it's Royal Bank, then the price and everything will appear here. You can decide to put the number of units. If you want, you can put the buy date. You're not forced to do it. Average cost, same thing. That is more for you. We, as mentioned earlier, we are building more features around the Pro membership. One of it will be that you will be able to download your customized quarterly report, giving you the summary of each of those stocks in your portfolio, tell you what happened during the earnings, what are the pro rating and the dividend safety score. And at the bottom, you can easily see your sector allocation. So you can see here that I have a lot of stocks in the tech world, a little bit more into consumer cyclical as well, and then financial services. So that's are my three major sector. If I want, I can play around with that to make it a little bit more diversified. I do have the pro ratings showing like the exceptional buys, the hold, the sell, or the screaming sells, which hopefully I don't have it here. And here you will have the dividend safety score. So what you want here, and I call it my lifesaver because you look like the colors are pretty much like a lifesaver and I love them. But you want to have the majority of your portfolio to show dividend safety score of 4 and 5. A little bit of 3 is good. This part needs to be worked on. You have to consider that, say, well, what's happening here? That's very important. So this is how you can, there you go. This is how you can use DSR to create your portfolio, improve your rating, and then you can protect your income with the dividend safety score. This is the last time you can get this this price. It's a lifetime discount. And on Monday, May 31st, 11:59 p.m., the coupon code will disappear. Well, it will not disappear. We'll just stop working. And when I wake up on June 1st, I will increase prices. So it will be $199 for DSR and $299 for $399, sorry, so $400 a year for DSR Pro. One last thing that is coming up shortly. And Richard, you're asking what's the difference between DSR and DSR Pro? I'm glad you asked. So with DSR, you have access to our portfolio models, the weekly newsletter. We have a buy list there for retirement and for growth investors. You have the stock screener and the stock analysis. Then if you are a pro member, you can create your own watch list. So when you're on the stock screener and you select stocks that you like, you will have your own watch list on your side. You will be able to create your portfolio on the website. And we will also send you a Google Sheet where you can enter your portfolio. Then this is one great improvement that we're going to do in the upcoming months. At the end of this year, actually, just working with the financial web the web firm that did the stock screener to do that. But we're going to merge the Google Sheet with the platform, and you'll be able to download your portfolio report. So every quarter you have a portfolio report, and you can actually, I'm going to show that to you in a second by sharing my screen again, because that tool is amazing. So if you go back to the webinar deal, it's Dividend Stocks Rock DSR-webinar-deal. If you go a little bit down right there, you'll have the features. So there's a video explaining you the features of DSR. So you have the time to look at how it's done. And then you'll have an example of the pro report that you are receiving every quarter. So the next one will be sent towards the end of June. So perfect timing to subscribe now. You subscribe, you fill in your portfolio. you're going to have your sector allocation. We're going to tell you your average yield, the expected annual payments, how your distribution is done in terms of pro ratings and dividend safety score. And most importantly, you will have the summary of your portfolio. So the weight of each of your stocks, the ratings. If you have stocks that have weak ratings, we're going to offer you a list of potential replacements. So then let's say you have a company that has a rating of 2 or a dividend safety score of 2. We're going to pull out stocks with better ratings in the same sector so you can look at them and go on the website and read about these stock analysis. And after the potential replacement, you will get the summary of each quarter. So you'll have, like, say, alimentation cauchemar, so earnings, revenue, dividend declared, what the CEO said, what we say about it, the link to the press release, and the DSR stock card. So you can have the analysis that we do for the overall company at DSR. And on top of that, if you need to dig it a little bit deeper and understand what happened because there's a huge fluctuation, well, you can see it with the press release. So all of that for DSR Pro. And what's coming in the upcoming months, actually, Vero is working on that. It's a big project of her for DSR Pro members only. You will have the chance to subscribe to a private Discord channel where we can all communicate together. We have over 1,200 DSR Pro members, so pretty much half of all our members are DSR Pro members. And I'm going to chime into that channel from time to time to have like audio chat with you guys. So either a morning coffee or a happy hour, so we can discuss specific topics, specific stocks. Stay there for like 30 minutes, an hour, just to discuss and benefit from everybody's experience and thoughts about the stock market or the economy or strategies. Yeah, it will look like Clubhouse. But I want to make sure that I have like control of everything on my side, but it will be similar to Clubhouse on that part. So that will come also for DSR Pro members only. So enough with that. Now let's go to the Q&A. We do have already 27 questions. What I'm going to do now is I am going to go from the oldest one and going down. And while I'm answering the question, I cannot see your comments. So from time to time, I'll try to look at the comments just to make sure if there's anything in the chat. But if not, Véronique will take care of that part, because it's easier for me to do both at the same time. Oh, and before we do that, I just want to thank you again for being here. And I'm going to share with you 2 newsletters that summarize what we have seen in the presentation and go a little bit deeper in some topics. So the Dsr Retirement Newsletter 1 of 2 and 2 of 2, you can download them. They're 100% free. Those newsletters were sent last month, I think, in April, to our members. They are part of our DSR fundamental newsletters. Those are like more evergreen. We're talking about strategies and stuff like that, and we update them on a yearly basis. So next year, we're going to do a refresh of those companies, of those newsletters, to make sure that they're up to date, to add a little bit more thoughts on them. And we do that throughout summertime. So we have like fundamentals newsletter, and then we have others newsletters like the buy list, which is giving you fresh ideas every single month. We track them. We tend to outperform the market very well. We started that in 2018, and it did very well so far. So it's great. And we follow them. So it gives you great opportunities to, if you go and you register today, you look at our portfolio and say, yeah, well, it's nice that you have Apple in your portfolio, but it's been so long, I'm concerned about the value. So I will instead look at the buy list to see if there's a tech stock that is getting hammered right now, and it's a great opportunity to jump in. So now let's start with the questions. First questions from Mia. Any comments on Sylogist? That's very interesting. Sylogist is a great company, well known at DSR, because I've told them a lot before they entered the TSX. The company has almost no debts, great dividend growers, and they work as a SaaS, so software as a service. Most of their clients are government and schools. So there are a lot in the municipal business as well. They help them to manage their information system, obviously. So for school or for municipalities. And what happened recently is they changed the CEO. The new CEO is more about growth. They announced a bolt-on acquisition not too long ago. Stock price went from like $12 or something like that to 15, and then it kept going up because it entered the TSX. It was on the TSX Venture before that. And I'm not just going to tell you, usually I don't go too much in the TSX Venture, but this one, I mean, 9 consecutive years of dividend growth, I could not let that go, especially because before that acquisition, they had 0 debt. So it's a cash flow machine. Now, the latest quarter was not that great. And because of that, the stock price dropped drastically. A lot of people could be, well, drastically. Now it's around $14, but it was almost reaching 19 not too long ago. You have to give some times. It was a disappointing quarter. Revenue were down, earnings were down, but it's not most of the earnings were related to the acquisition cost and the compensation for the CEO. So it's not necessarily something that is going to happen every quarter. And moving forward, I see that what I like about the new CEO is he's making great acquisition that will being integrated in the business rapidly because it's the same type of business, and they just combine expertise and they will gain scale. Already the next one will offer double-digit revenue growth in the next year once the integration is done, and they have increased their line of credit to make more acquisition like this. So for a company that has a great history so far, they know what they're doing. They're very stable. I'm not worried, and it's probably a great buying opportunity. All right, so next question. I'm Mike and Vero. So, hey, Greg, I have 2 questions. I like that. Looks like AT&T trying to deleverage its balance sheet, and in the process, it is cutting its dividend. Is it a sell? That's a very good question. We kind of like AT&T before that, not a long time ago. We started to like it actually only in 2019 when they started to generate more cash flow and pay down their debts. That's when we started to say, hey, you know what? I kind of like that idea, especially for a retiree. Now what they do is that they do a mega merger with Discovery. They will combine all the medias, create a new Warner Media there. That will be in a much better position to fight against Netflix and against Disney and Amazon Prime Video. The future of content is in streaming, and you need a wide portfolio, a broad portfolio of content to be able to compete against those giants. So I think that's a smart way to do it. The problem is AT&T, during that deal with the spinoff, they will get a better balance sheet. They will gain financial flexibility. So it will be good for them because they can concentrate on buying more 5G spectrum and go head-to-head against Verizon and T-Mobile in the US. The problem here is they have set a new rule for payout ratio that after the spinoff, and it will most likely generate a 40%, 50% dividend cut, which, I mean, if you just focus on income, as I discussed before, it's pretty much a slap in the face for all investors. So from a business perspective, I like the move. On the other side, as a dividend investor, not the best deal. I would hold onto the stocks right now and see what's going forward. The expected yield once the transaction is completed, which will be in 2022, should be around 4 to 5% yield, which is still not that bad. And the stock value should not be affected that much. I mean, they took a beating now, but now it should be pretty stable. So it's not the end of the world, but obviously I'd prefer companies like TELUS or Bell in this place. So your second question, do you think it has an implication for your other telecom recommendation, TELUS or Bell? I don't think so. A few years ago, Verizon considered entering the Canadian market. And after further study, they said, you know what, that's not worth it. There's a big difference between the US and the Canadian market. And it's kind of funny because it doesn't make sense when you think about it. We're in North America. We're pretty much like same system, same economic system as well. But, it took decades and decades and lots of failures for Canadian banks banks to actually make money in the US because they did not understand how it worked. And now you want to enter into the Canadian market. It's an oligopoly. Now it's going to be like 3 players if the merger with Rogers and Shaw combined together. So for the wireless, it's going to be incredibly difficult for them. And I think that if AT&T or Verizon tries to enter the Canadian market, it will look a lot more like Target attempt to go in Canada than anything else. So I don't think it's going to happen anytime soon. And I think they're going to play in their playground and they'll be happy. I really love TELUS because they have other type of growth vectors. They go into artificial intelligence with the spinoff of TELUS International. They go with TELUS Agriculture, helping farmers using AI and technology to manage their farm, which is amazing. And TELUS Health, obviously telemedicine, that's the future. Very trendy with the pandemic for obvious reasons. So I like this out-of-the-box mentality that you can find at TELUS that you don't find at Bell. So Bell's a great deluxe bond, so as I like to call them. So great yield, safe yield, but not necessarily expect the stock to surge like there's no tomorrow, but very classic with the media and the broadband business segment. Craig, maybe one more question. Wow, I like that. You're on fire. If you're trying to max out on dividend growth, total return, is there a sweet spot you look for a term of yield or percentage? Personally, right now, my portfolio is at 2%. I'm pretty sure that I would try to get closer to 3. Between 3 and 4% would be my safe spot at retirement. Mostly because I don't want to get stuck into do market timing. So if I have 3 to 4% yield and I have like a 12, maybe 15 months cash reserve at this point, so I can time if I need to withdraw a little bit more than 3-4% of my portfolio to suffice my retirement budget. And again, it always depends on how much you invest and how much you need at retirement. You know, if I have 3 million at retirement, I won't have to worry about anything. And unfortunately, maybe I will not have 3 million at retirement. That's another story. So 3-4% would be my target here with a decent 3-4-5% dividend growth rate every single year. So you can have like a few stocks that don't increase their dividend year after year, but a very small portion, maybe like 10-15% of your portfolio. The rest should be geared toward dividend growers, even if it's a small one. CMF, Mike, thoughts on the few remaining perpetual preferred shares? That's one of the rare places where you can generate healthy income without any problem. There are not that many because and the only thing I want to say about preferred shares is that they're great. I mean, if you're going for Canadian banks, for example, you don't have to worry too much about their balance sheet, and they'll be able to pay you very well, and the yield will be a little bit better. I still prefer to be able to participate in both capital appreciation and the and get the dividend. The downside of preferred shares as well is they're not that liquid. We saw what happened if you needed money in March 2020. That was kind of crazy. So you better rely only on the dividend income, because at that point, even preferred shares price, they dropped like crazy, for no apparent reason besides the fact that they're not that liquid. However, it's a good way right now because bonds don't offer much. It's a good way to protect your portfolio and bring some stability inside as well. Kim, you're saying, Mike, do you mean that Scotiabank isn't a good stock? It's not that it's a bad stock. You know what? All top 6 Canadian banks are great for obviously the sectors that they operate in, but Scotiabank is not my favorite one. You know, their narrative for years was we invest in international markets, most in emerging markets in South America and in Mexico and Central America. And those countries, their economic growth expectation is a lot higher. They should outpace their growth compared to the US or Canada. For obvious reason, they're smaller, so it's easier to grow faster. So if they grow by 5-6%, it's a lot better than Canada and the US. And that's been their narrative. Say, oh, we're going to benefit from this economic growth while we sit and relax in Canada. The problem is they've never been able to show strong results compared to other banks. They have been lagging for the past 5 years, 10 years, 15 years compared to all the other banks. And for that, and I've bought Scotiabank back in 2013 or 14 based on that narrative. And then after 2 years, I realized that they were not able to keep up. So I definitely prefer National Bank and Royal Bank. Royal Bank because it's one of the largest and they are well diversified. So 50% of their business, classic banking activities. So we're talking about savings and loans. And the other 50%, it's wealth management, capital market, insurance. So great ways to generate growth regardless of what's happening. My favorite one, National Bank. Maybe because I'm a bit sensitive. I've worked at National Bank for 13 years, 10 years as financial banker, financial planner, and private banker at Private Banking 1859. And in 2016, I decided to take a pause there, and I hopped on a small RV with my family, my wife and my 3 kids, and we drove all across North America and Central America, ended up in Costa Rica for 3 months. And then I realized that it was great to be a private banker and help 300 clients, more or less. And now instead with DSR, I can help thousands of investors. And I found that it was a lot more rewarding, and I love to spend time with my family. So having an online business gave me that flexibility that I didn't have as a private banker for obvious reasons. And long story short, National Bank, a lot of growth. They make a lot of acquisition in the US and in Cambodia, strong capital market, and great wealth management. And I think wealth management will be a great growth vector for the next 10 years, especially as loans and savings are being more commoditized. Like, like mortgages, you just shop around and you pick the best rate, and that's pretty much it. So if you go with wealth management, you're going to get a lot more loyalty from your clientele. Karen, would you sell weak stocks even at a loss? Definitely. Honestly, when you look at a company, that's a very good question. When I look at a company, I don't care how much I'm making or how much I'm losing. I look at my investment thesis. And then when I look at the investment thesis are all the good reasons why I bought the stock in the first place. And when they're not there anymore, especially like I'm going to use the Scotiabank example there. So my investment thesis was the narrative about international exposure. Didn't happen for a few years. I realized I went back. It's not happening that much before. It doesn't seem that it's going to go further as well. So this one, I was making money. That's fine. Another one, I'm not making money. I'm going to sell anyway. You know what? When you lose money and you wait, you may be waiting forever, or you may be waiting for 5 years or for 10 years. And during that time, your money is not making a single dollar. So instead of waiting maybe forever, I mean, if you have shares of Vermilion Energy right now, VET, it lost 80% of its value. So you need the stock to, I don't know, go 5 times its current stock price right now. What are the odds the next 5 years it goes up by 5 times? I don't know, but it doesn't look good. So you may end up waiting for 20 years and still have this money lost in your portfolio. So don't look at how much you lose or how much you make. Look at your investment thesis and where the company is going. If you have weak ratings, it's the weak stocks, you sell, you move on. And a good trick for that is to get excited about a new stocks. So build your replacement list. If you use DSR, you have a replacement list already there for you, or a buy list. You look at a stock that you love and you say, oh, I wish I had the money. You go back to your portfolio and then you realize, oh, this company is not good. You sell it, you buy the stock that you love now, and then it's going to be a lot easier to get rid of your losers. We do have actually a Dsr fundamental newsletter about getting rid of your losers that covers a lot of points there. Louis, or Louis, I don't know if you're French or not, sorry. Do you have a limit, max percentage of your total income stream? Not sure I understand your question. I'm going to go back in the chat. Can you, sorry, Louis, can you add a little bit more on your, because I'm not too sure I understand. Do you have a limit, WRT max percentage of your total income stream? If you can add some comments, or if not, I will go back to the question and then maybe go back later on. No, so sorry, it's not gonna happen. James, yeah, don't worry. If you forgot to put the coupon code today, it's going to be changed. If there's any, it happens like from time to time. You just like type too fast and then you register because you're all excited, and then you realize, hey, dude, I paid too much. We're going to review that. Okay, so just waiting for you, Louis, for that question. I'm going to take a sip of water. Okay, I'm going to answer a question and I'm going to get back in the chat, so you'll have your answer anyway for sure, okay? All right, so go back here. In the meantime, Emily, when do you when you do the weaker rating twice a year? At DSR, we actually review all our stocks quarterly. I do that for my own portfolio. Most of the time, the ratings won't change from one quarter to another. Obviously, it's not playing ping pong here. The same rating could happen for like 3 years in a row, and that's fine. But it is being updated on the website every quarter. And when we do it, in the latest quarterly information, we put the date over there. So you know when the latest ratings has been reviewed. And the stock analysis, the complete stock analysis being updated twice a year. And all the metrics are being updated daily. So you have fresh metrics to do your analysis, quarterly metrics, quarterly ratings according to what happened in the latest quarter. And then twice a year, we'll look at the business model because, you know, let's be honest, Starbucks will remain my Starbucks for a while. So it's not changing that fast. Okay, Louis, so for any given position, it will return an income stream. Do you have a cap to the maximum of income stream? No, I don't have a cap in terms of income stream. I have a cap more about the exposure of the size of the stock. So technically, it could pretty much look like the same. So if you have a large position in a stock, probably that it will generate a lot of income, but I rather look at total return, so it will be more income and the capital. So by looking at the size of the stock in my portfolio, it will tell me my cap personally is 15%. If you look at income, I would probably try to get something lower than 10% because you don't want to lose 10% of your income right away. Imagine a dividend cut on a 10% of your income. That's 5% of your budget right away. Depends on where you are in your life and how you feel comfortable with that, but you have to consider this seriously in your retirement plan, how it could affect or not going forward. Rod, how does Mike deal with currency fluctuation? I am 80 and don't have a long time horizon as him. Yeah, you're right. We have a few years difference. Let's put it that way. So far, I'm only in Canadian stocks. This is a very good question. Right now, I would say that at roughly 120 to 1 for the US versus the CAD, it's pretty much a good time to go and buy a few US stocks. You know, even yeah. At 80, it gets a bit tricky. Personally, I think that if you have at least 20 years in front of you, which let's be honest, it might not be the case, but at least 20 years, you should not worry too much about currency fluctuation because it's going to go up and go down. So I think that Canadians should have roughly 50% in US, 50% in Canadian, mostly because it gives more diversification and more growth power moving forward. At 80, if you're already in CAD stocks, we do have a 100% Canadian retirement portfolio and 100% growth portfolio for Canadian as well, without looking at US stocks, and it does still very well. You probably don't need that much US exposure at your age for that reason. And I would probably just go with the retirement CAD as an inspiration. That will probably be enough. If not, you may want to get maybe 10, 15% to put a little bit more spices in your soup to get a bit more growth. I don't think you have much risk at 1.20 to 1. Let's face it, our Canadian dollar is pretty much a petrol dollar in the sense that, yes, we have a diversified economy, but when the oil price surge, or dollar surge as well. And this is what's happening right now. So at 1.20, it's pretty in line with the average of the past 20, 25 years. So I don't think there's too much risk over there. Mauricio, Enbridge outlook, please. Concerned about line 3 and line 5 outcome. See, it's kind of funny because it was probably a more important news for the media than for the company itself. Media have been running on the potential closing of the line 5 for the past 3 months, but in reality, Enbridge just said, you know what, we're going to keep doing what we do. We follow our contract. We believe we follow our contract. and now we're going to settle that in court. And until a judge tells us to stop the pipeline, we're not going to stop it. At the same time, they do have the approval to continue to work to do the new Line 5. So their point is just saying, you know what? Right now, we need the old Line 5 moving forward. And let's be honest, the world needs energy. So regardless if we are pro electric vehicle or if we are pro oil sands or whatever, we need that gas, that oil to go from one place to another. And the safest way is probably pipelines. Yes, it has risk. That's definitely a problem. But going with trains and trucks would just create a lot more pollution and not necessarily decrease the risk. I live in Granby in the Eastern Township. We're like 2 hours away from Lac Mégantic, where there's that catastrophe that happened a few years ago where a train full of oil exploded there. It burned pretty much half of the village. So you know what? That also has consequences. So going forward, I am not concerned about Enbridge. They've been doing with those kind of deals and problems and challenges for a very long time. They have a healthy cash flow generation, and the yield is safe. Véronique, maybe you can put the YouTube video that we discuss Enbridge as well to give you a little bit more information over there. But I do have Enbridge in my portfolio. It's a very small position, but I'm not concerned right now about what is going on. Paul, TD has a negative fair market stock valuation by analysis. It is trading above fair market value currently. Yield is 3.6. Why do you think the analysts are indicating that TD is overvalued? You know what's funny about valuation is you will put 10 CFAs in a room, you're going to ask them the value of TD, and they're going to give you 10 different answers. At one point, what's kind of funny, I remember I was looking at Couche-Tard, which is one of my favorite holding, and the analyst range was like from $30 to 65. So pretty much you have your dartboard and then you throw a dart and then you close your eyes and you get a value. I don't believe in short-term valuation. I've done several research in the past, and whenever I look at analyst calls on what they think that the stock will be worth in 12 months from now, 95% of the time they're wrong. So I don't really care about what's their valuation about TD or about National Bank or Royal Bank. Look at TD, look at their business model, and ask yourself if the company will be worth more or less in 10 years from now. If you believe that the answer is yes, well, then you buy it, and there you go. You have a great bank in your portfolio. And this is how I've managed my portfolio. And sometimes, you buy a stock at its peak price, and you have to wait a few months or a few years. I bought Starbucks in 2017. I had to wait almost 2 years. I was down maybe 5-10% during that 2 years period of time. And today I'm up like 70% on it or 80% on it. Like, it's just a matter of making sure that you have thriving businesses that will go through several business cycles successfully, and you'll be good with that. So I never follow what analyst says, and you'll see we use the dividend discount model at DSR as a comparison tool. So if you hesitate between TD and Royal Bank, you can look at their dividend discount model to have a good idea, but we don't use it as say, oh, it has a better valuation, like it calls at 400, like at 40% increase, we're going to buy it. We don't believe in that at DSR. And I know it's counterintuitive, and I know I'm against the current here, but it has been working for us for several years. DSR exists since 2013, by the way. And if you look at our portfolio returns, we beat the market. We average roughly like 14-15% annualized return since 2013. So we've been doing very well. I'm not saying that's what's going to happen in the future, but just to give you a little bit of background here. Karen, are REITs a bigger risk with the current fallout of COVID? It depends on the REIT subsectors, actually. I am not a big fan of retail REITs, especially shopping malls, for obvious reasons. Before the pandemic, e-commerce trend was about 20% of retail sales. Now it's like 25%, that only in 12 months. Moving forward, this was a trend that was already growing. We all know that, but it's going to continue. But if you look at apartment REITs, which many of them has taken a beating and they have not recovered yet, It's a great place to look. Industrial REITs are amazing. One of my favorite is Granite, GRT.UN. They have Magna International and Amazon as their main tenants. They specialize in high-tech industrial facilities. Amazing business, grow by acquisition, increase their dividend at the same time. That's perfect. One retail REIT I like actually is Canadian Tire REIT, CT REIT, because they own Canadian Tire properties, and Canadian Tire is not going anywhere. They just reported like great results not too long ago. The pandemic forced them to invest massively in their e-commerce web platform, which is about time, which is great. But they own a lot of their brands, which makes them iconic for Canada. And you cannot buy Motomaster or Motorcraft or stuff like that elsewhere. So that makes them a little bit more e-commerce proof. So I'm not worried about REITs in general. Besides retail offices as well, we can see that yes, people are going to go back to work in offices, but some from time to time not going to happen full time. Sometimes like you're going to, maybe you had like 3 floors and now you only need 2. So those are places I'll be a little bit more cautious about as well. Again, the key here, look at the dividend growth. If the dividend is not able to increase over the past 5 years, keep that in mind. Super low interest rate. Before the pandemic, consumer confidence to the top. Low unemployment rate. So people has job, they have money, they have confidence, they spend, and this REIT is not able to increase its dividend in the perfect environment. What's going to happen when we hit a recession or a bump road? Well, dividend cuts are going to happen, and you have to be careful with that. So this will be one of my key points when I look at REITs. Obviously, then you have to look at AFFO payout ratios and FFO payout ratios. We track those at DSR as well, and we mentioned our appreciation of the dividend safety and the AFFO payout ratio quarterly to make sure that you don't miss a beat. Mauricio, what about preferred securities? So we already discussed the preferred shares before, so that's good. Opinion from Connie, opinion from FCR.UN. Just bear with me, FCR.UN. First Capital REIT. Let me see what it looks like right here in the stock screener. Won't be long. So FCN.TO. Oops, I had my previous filters, maybe. Just FCR, that's why, FCR. Don't like it that much, actually. Pro rating of 2, dividend safety score of 2. The dividend has been cut twice. For me, a dividend cut is already a good reason to sell. 2 dividend cuts. What are the chances that they're going to turn around and be the best REITs ever in the next 5 years? I don't know, but I don't think it's a good one. So I don't have the fresh analysis in my mind, but when I look at the dividend triangle that I've discussed with you earlier, you know what? I'm just going to show you on the screen. It's going to appear very clearly. So that's the dividend triangle. So you see the price that dropped obviously with the pandemic, but you see that revenue is going down. Earnings per shares for a REIT, we should not look at it. That's for obvious reasons. But when you look at the dividend, I mean, no increase for a while. And remember what I was saying about the absence of dividend growth being the first step to a dividend cut. We get the problem. We have a cut, and then we have another cut. So definitely no go for me on this one. I don't see that company to be a good fit for a retirement portfolio. But that's just my opinion. Karen, what's your view on the future of Lemonade? Is it a company or a joke? Lemonade, really? Oh, that's a real company. Sorry, I wasn't sure. Since it doesn't pay dividend, I have no clue. I never looked at it. And see, I just thought you were talking about the drink. I'm looking outside. It's pretty sunny. It's like 30 degrees here. So I could use some lemonade right now. SS, your view on fixed income in retirement portfolio. You know, in an ideal world, I would love to retire and buy like provincial bonds or state bonds or stuff like that, like secure bonds paying me like 5-6%, and I don't have to worry about anything. Unfortunately, it's not happening right now. And for that reason, I think it's safer for your portfolio to look at what I call the Lux Bonds, which are companies with like utilities, for example, that are very stable, that will give you a good yield, that will increase their dividend year after year, but the stock price will not move that much. Power Corporation is a good example of that as well. In the utility business, you can have companies like Consolidated Edison, Duke Energy, Xcel Energy in the US. In Canada, Fortis, Emera, Algonquin are my favorite. Those are the companies that could be very stable in your portfolio and will be a lot better than bonds because we have low interest rates. Maybe another time we're going to have like great bonds at a great yield, and then it will have definitely its place in your portfolio. Right now, not so much. So try to focus on companies that has robust balance sheets, ability to increase their dividend, and at the same time that they generate something, they offer a service that people need, like utilities for powers or water. Those are given. Telcos, same thing. We need our phones and stuff like that. So those will be the sectors that we'll look at. Reits, obviously. Alex Edwards, why so few REITs have growing dividends? The thing is, a lot of REITs will focus on growing their portfolio of properties. And since they distribute, by definition, they must distribute most of their earnings to their units holders. So their sole purpose is to provide you with income. And that could become a problem down the road. And this is why a lot of them will issue more units to finance their growth. But as you increase the number of units, you increase the total dividend paid. So if you're paying $1 per unit and then you have 1 million units, that's $1 million in dividend. But if you go from 1 million to 1.5 million units, now you have to increase your dividend payment by another $500,000. So you just generate more funds from operation, but you just redistribute that to new shareholders. And this is why it is more difficult to find REITs with decent growth. As I mentioned earlier, focus those that at least have 2-3%, at least that you protect your portfolio against inflation. And it shows that the REIT is not only adding more properties to their portfolio, but they're actually generating more funds per units. That's very important. All right, Lloyd, do you think that CDZ is a sleep at night solution? CDZ. Yes, I mean, Canadian Dividend Aristocrat ETF. If you don't want to spend too much time on your portfolio and you rather have a professional doing it for you, going with Dividend Growth ETF is definitely a good way to do it. The reason why I don't like ETF, it's not I don't like, they do the job perfectly, but when I look at their top 10 holdings, I always find companies I don't like, and I prefer to do it myself. That's a personal choice. Some people will prefer to have the ETF rebalance every year and then be done with that. That totally works, and it's a good sleep at night solution. Paul, you're asking, where's the part about decumulation? We talked about how you can create the yield from your portfolio and how you can withdraw money. Obviously, I cannot tell you from which account and how you can do it. You need a financial planner and you need an accountant to tell you that. Different persons, different solutions. For example, I have RSPs, I have a Lira, and I have a business. So the solutions for decumulation on for my own situation is completely different for someone that has built a huge RSP and has nothing else versus someone that has a pension plan and has some RSPs and a TFSA and so on. So we cannot go and say, oh, you need to do this, this, or that. For this kind of plan, I strongly suggest that you pay for a fee-only financial advisor, a financial planner. It will cost you maybe like $2,000, but you'll get a plan of withdrawals, which will be tax optimized and it will be a lot better for you. Dan, what are your thoughts on Gibson Energy? From the best of my memory, that's another one that cut their dividend last year, isn't it? Let me see here. In general, I'm not a big fan of the energy sector, as I mentioned earlier. I haven't looked at Gibson Energy for a while. No, actually, the dividend increased, so that's good. You know what? If a company in the energy sector has been able to increase its dividend, this is definitely a good point for them. But unfortunately, I haven't looked at this company for a while, so not necessarily in my basket of interest. Sorry about this one. Scott, do you have advice on programs on moving RSP to TFSA? That's very interesting. I don't have anything for programs, and if you don't go with a financial planner, a couple of rule of thumbs. Remember that in your TFSA, you have a withholding tax on the dividend if you invest in US stocks. So not on the capital gain, but on the dividend, there you will have to pay 15%. So if you want to move stocks there, make sure that they're low yielding stocks. If you move a company like AT&T, you're going to get hit big time. 15% of the dividend will disappear. So you don't want that. Now, every time that you withdraw money from your RRSP, it's going to increase your level of income. So you want to look at your tax bracket and you want to look at your other sources of income to make sure that you can balance it out. And sometimes it's worth it to withdraw more money from your RRSP before it becomes a RIF. And then you are forced to withdraw money from your RSP. There are no perfect solution. Once you withdraw the money from your RSP, you'll have to pay taxes, and then you send them to your TFSA so they can continue to accumulate on tax sheltered. But then again, focus on US stocks, keep them maybe in your RSPs as long as you can. High yielding stocks, same thing there. And for the others, you can go with the tax bracket to make sure that you always minimize that and you don't go over certainly depending on your province. Those things changes from time to time, but I would do it this way. Obviously, a financial planner will be able to run a financial planning program and show you how you can do it. If not, you can manually do it with an Excel spreadsheet that will work as well. So you go in any accounting firm like Ernst & Young, for example, they're going to give you the tax bracket for each levels in your province, and then you can manage to withdraw just the right amount. But unfortunately, there's no perfect solution. LJ, you asked the difference between pro and regular membership. Pretty much I answered that question. If not, you can go on that page. It's well explained. The biggest difference is about the portfolio manager tools, where you have online support and then to create your portfolios, and then you have the quarterly summary of all your holdings, and you'll have the forum as well that is coming up in a few months. Emily, do you have suggestions for 35 years old to get started? I want to start building my portfolio for retirement. So if you start right now, I mean, first you start right now. That's the first advice. If you don't have like at least $10,000, I think that going with ETF will be a lot easier because you save on management fees and transaction fees until you get at least $10,000. And then if you're interested, you start buying shares like, let's say not more than 10% of your portfolio per stock. So at least start with 10 position at 1,000 each, for example. We do have a 25,000 portfolio model at DSR to help people starting. It has 10 position. So regardless if you have 25 or $10,000, it's pretty much like the classic range. And then just design the sector allocation that you want, and every single month add more money. Never look at the market fluctuation. Just keep adding all the time. Follow your plan. You know what? If you have a good plan of investment, so you select your sector allocation, you create your buy list, and you start buying those stocks, and you do that month after month, and you follow those simple rules, you're gonna have a lot of success as an investor. The key here is to not jump from one strategy to another, not try to do speculative plays at the same time. Later on, as you gain experience, you may allow 5-10% of your portfolio for speculative plays. That's what I do with my portfolio. I honestly, I rarely, like my limit is 10%, but I rarely exceed 5 for some reasons. I don't want to take that much risk, and dividend growth investing works so well for me that I don't mind not like passing like the next Facebook or the next Tesla. I don't necessarily need it in my portfolio anyways to achieve my investing goals. Ben, would you like an explanation on dividend income from stocks versus income from CEF, especially with those with leverage? CEF is closed exchange funds, closed-end funds, sorry. Yeah, closed-end funds. The thing is, when you go with those funds and they use leverage, a good part of your money is pretty much stuck in the black box where you don't know exactly how they use the leverage, how they use the options, and how they will generate the income out of it. It's pretty much falls in the line with the other products I've discussed today where you don't know exactly what's happening and then you get the money back. But sometimes, especially if they use leverage, it's going to look very good when the market is doing well, but when the market goes down, you have to consider margin calls. Margin calls happens when you invest $100 million and then you borrow another 50, and then the bank says now you have $150 million in assets under management. The day it goes under 120, you have to put more money in. And if you don't have that money, well, we're selling everything. That's how a margin call works. So when the market drops, we saw that with crypto yesterday. That's what happened. We saw that last March. We saw that in 2008. The market starts dropping. Some investors must sell, and then it drops a little bit more. Margin calls happen, and then a bunch of funds are selling their things at the same time, and it crashes the market every single time. For a retiree, I don't think it's a good thing. I don't think this is the kind of risk you want to take at retirement because you don't necessarily have that much time moving forward. So this is why I prefer to not necessarily use leverage in that kind of situation. Peter, how many dividend stocks should I have in my retirement portfolio? It depends a lot on the how good you feel about reviewing them quarterly. I think that between 20 and 40, that's the magic numbers. But if you're closer to retirement, you probably have a large portfolio. It's probably easier to have like between 30 to 40 stocks. Personally, I have like 33 right now, but I follow them every quarter. Every quarter, I read their quarterly statements and I make sure that they stick with my investment thesis. I don't care if I make money or not on those. I want to make sure if the company is still going towards the way I wanted. So that will be the magic numbers between anything between 20 to 40. In your case, more likely around 30 stocks. And that over that, you're just going to look like an ETF anyways. George, I have a mix of stocks and equity ETF. How does Pro handle the ETF? Right now, what we do is you can enter them and they will show as ETF. We are working on an upgraded version for Pro to have them with the price updates daily with all the other stuff. That's going to come towards the end of the year. We don't do analysis of ETF though, so it will still be considered as a core portfolio that is well diversified. You have the ability though, if you have, like say you have an ETF covering the tech sector and it's only about the tech sector, you can select the sector that it will show in your sector allocation. So that's great. But if it's a diversified ETF, like ETF tracking the aristocrats, for example, it will just show as ETF with no sectors. So it's not perfect, but our platform is for dividend growth investors, not for ETF or all like the thousands of different products that we have in both Canada and the US. I wish we could, but at one point we have to limit ourselves. George, is this an appropriate platform for a non-registered holding company portfolio, which is where the bulk of my stocks are? I say yes. I mean, we do have 100% Canadian portfolio that is more geared toward growth. We have another one for retirement. We don't address the issue of taxes because we have about 60% of our clientele that is Canadian, 35 American, and then 5% going from offshore. Most of them are European. So going taxes, it's not what we do. But definitely if you want to manage your portfolio using dividend growth stocks, you'll find your answer there. I know that I have several clients with corporate accounts at DSR, and they use Dsr Pro, and they're super happy with that. Because in the end, I mean, it's all about the strategy, and it's all about reaching your investing goals. Cameron, do you have an opinion whether Dsr and Dsr Pro are tax deductible as investment expenses for Canadian personal tax returns? As per the classic definition, I'd say no. Most of the time, that's what I've seen, but I'm no accountant, so my suggestion is to go with your accountant and look at it. But since we're not charging you for advice or fees, it's not like if you go private wealth and then your fees are tax deductible because you're getting advice. We don't give advice. We provide you with tools and information, so it's fall into the newsletter category in terms of taxes. So I would bet $2 that you cannot write those this fee in your tax report. On the other side, I mean, if you pay for Pro, it's $200 a year. When you look at your portfolio and in management fees, I'm pretty sure that within the first month, you're going to get more than $200 of value. You're probably going to get a few $1,000s worth of value. And just for that, your fees will be paid directly. And I would not see as a fee. I would see that as an investment. You know, just when the market crashes, and I've done all those webinars, I've helped people not panic and not sell at the bottom of the market. And they probably saved like thousands and $10,000s of dollars at that point. So definitely just with those 2 months, they paid their membership for life. Steve, what does Mike think about holding preferred shares within the cash reserve? Oh, that could be an interesting thing because they don't move that much and they generate income. So if it's not all your cash reserve, that's a very good way to generate income at the same time of having a good parking lot. Just remember, they're not super liquid. So if you need, like, just have a mix of cash and preferred shares, but that's a very smart idea. Thanks for that. I would add that to to my newsletter and next year when I refresh it. Thanks. Heather, what would prompt you to reduce or sell a Canadian pipeline company? First one, you have to track the distributable cash flow, payout cash flow. So distributable funds per share versus the dividend. So you have to make sure that it always increase so the dividend is safe. We do comment on that quarterly at DSR just to make sure that we follow that, because this is not a metric that you will find in any stock filters from the best of my knowledge. So I want minimum dividend increase. So a company that doesn't increase its dividend for 3 years is not in my portfolio. That's one of my number one rules. And then you have to look at the debts and their ability to pay down debts, because I mean, it's fun to grow, but at one point in time, debt is cheap today. It may not be cheap in 10 years from now. So you want to make sure that a company has enough projects that will generate cash flow and manage their debts, and go with dividend history. You know, like companies like TC Energy and Enbridge, they show several years of dividend growth. They show DCF payout ratio that are well in line, like under 70%. So that makes the dividend safe. And those are like the reason why I would keep them if they become shaky. And I see that the DCF is like slowing down, and now they're getting like the payout ratio going closer to 100. I'm not going to wait too much, because this is the kind of company that could get very nasty very fast. We saw that with several MLPs in the master partnerships in the US. So you don't want to get there either. Bernard, what do you think about Lion Electric Bus, a Quebec company? Are they on the TSC? Unfortunately, Lion Electric doesn't pay dividends, so I don't follow it. That's more into speculative plays than anything else, so I don't have much to say about it. Sorry. Michelle, a question that came during our DSR private webinar. What do we do with IPL shares right now, Interpipeline? So for those who don't know, Brookfield Infrastructure already owns about 20% of IPL, Interpipeline, and they made an offer to buy all the remaining shares. I think it was $16.50 per share. Don't quote me on that. I mean, it's been already 2 hours. I'm answering questions, so I'm not 100% sure of the price, but long story short, right now the stock price is higher than that because the market expect a better value, so a higher bid. IPL on their side, they're just like, hey, that's not worth it. Wait for it. Wait for a better offer. We are value our shares, I think, close to $19 or $20. So they're trying to get the maximum out of it. And then Brookfield is just like, no, I'm sticking to my offer. Maybe I'm going to increase it, but I really want to have this deal done. Knowing Brookfield, I'm pretty sure they will sell that deal. What to do with the IPL shares right now? You know what? The company will not increase its dividend after cutting it last year. Right now, you're in a space that your bet is. I'm just going to pull out IPL. I'm just going to have. Okay, so right now the stock price is close to $18. Do you think they're going to get $19 or $20? That's a lot compared to probably like the 16 or 16 and 50 that is being offered. So just make sure. I mean, personally, I would sell and move on. That's what I would do. Like, just because I think there's like better options on the stock market than IPL. And I don't think that getting $1 more and maybe selling at $19 is going to move the needle in your portfolio anyway. And the dividend is going nowhere. It's going to stay there until this matter is settled. Actually, I would buy Brookfield Infrastructure instead. John, does DSR cover dividend stocks in foreign market like Japan and Europe? Not really. We have maybe like 5 or 10 ADRs that are very popular among Dsr Pro members. But for any great utility that you can find in Spain, I can name you 5 great companies here. For any Nestle or Unilever, you'll have Coca-Cola or Procter & Gamble here. So I don't know why we would extend there, and there's no signs that they will outperform the market. So we don't cover them per se. We have a few of them, but not too much. Definitely no from Japan, that's for sure. Harry, how much percent of allocation to gold in your portfolio? How about 0? Gold is a bet on fear, and that's pretty much it. You know that since their golden years, during the stagflation in the 70s, gold, if you include inflation, has not reached its peak price of the 70s. It's just a bet on fear, and that's what it is. So I rather, even during the market crash, and I'm 100% invested in stocks, 95% invested in dividend growth paying stocks. And when the market crashes, I look at most of my companies and I was like, oh, you know what? Alimentation Couche-Tard will continue to have convenience stores and people will go there. TELUS will continue to sell wireless subscription. Banks will do their things. Emerald will do powers. Microsoft, Apple will continue to actually thrive during a pandemic. Visa is still going to process transaction. Starbucks sell coffee, etc., etc., etc. Gold. If I take that marker and it's an ounce of gold and I put that on my desk and I wait 25 years, I will put it back and it still be one ounce of gold. So I like to buy productive assets, and gold has no place in my portfolio whatsoever. If you look at the long-term period, 20, 25 years, you're going to get a lot more growth. Yes, more fluctuation, but when you look at gold, fluctuation goes up and down all the time. And keep in mind that last year in June, everybody called for $3,000 an ounce of gold for Christmas. And now we're almost a year later and it's not even breaking 2,000. So I don't see the value there. Sid, are there any companies recycling lithium batteries that pays dividend? Wow. Albemarle is mining lithium, but I don't think that there's any companies recycling lithium paying dividends. If you want to go with EV stocks, Vero, could you put the video and the podcast about that? We have highlighted stocks like Texas Instrument, Gentex, Magna International, Albemarle, Linamar, that will be benefiting from EV cars, not necessarily directly to lithium batteries, but it's a good way to protect yourself from investing in something trendy, but still sticking to your strategy. Full disclaimer, I have shares of Gentex, Texas Instrument, and Magna International. I'm going to try to be a little bit faster right now. It's been 2 hours, but I really want to answer all your questions, so we'll try to go as fast as I can. Barb, your comment, please, on the new TSX cryptocurrency ETF. Well, if you want to invest in cryptocurrencies, going with ETF is a great way. Lots faster. It goes directly from your portfolio. You can do it with your RSP and your TFSA, so it's a great place. Keep that in mind. It's highly speculative. I personally have like 2% of my portfolio in that ETF, actually, just for fun. And It will never go higher than that because every time it goes higher, I sell and I buy dividend stocks with that. It was just a fun experiment for me, but I don't necessarily believe in that. The technology behind it is amazing. I think Ethereum is great because it's like layers of codes that you can build on. So it's really like an Excel spreadsheet with macros included, and you can use those different macros in different cells to build other applications. So going forward, the technology is amazing. As an investment, it's still a lot of speculation. Ian, how often are these stocks changed in the retirement portfolio? We have buy and hold mentality for most of it. So you can expect, regardless, retirement portfolio and regular portfolios, we will do maybe 2 transactions a year, maybe 1, maybe 3, but never more than that. I manage my portfolio the same way. I rarely make more than 3 transactions per year. Last year was an exception. I think I made 4. And the year before I made 0. So I keep the average around that. The key here is to select high quality stocks and let them ride. We will offer you monthly ideas though in the retirement stock. So 5 Canadian, 5 US that are being updated all the time. So it gives you fresh ideas and great moments to pick up stocks at a good price because they've been beating down, but we like the stock. So you have fresh ideas, but if not, you can definitely follow those very smoothly, not too many trades. I don't want to create more noise in the market. I actually want to reduce it because I think that people are making so much noise right now. It's really hard to be in a peaceful place with calm to trade. Michelle, me again. Are annuities parts of a good for part of your retirement plan? Yes, but annuities are usually the amount that you're going to get from your annuity will usually be in line with interest rates. So right now, it's not necessarily the best time ever. You're probably not going to get much out of it. When you look at how pension plans are calculated, for example, when I quit my job in 2007, in 2016, I took the pause. In 2017, I officially quit my job. I received my pension plan from National Bank. They gave me the offer of having an annuity or having the cash, so which is $108,000 or an annuity. The annuity was the equivalent that if I used that $108,000 and invested for the next 40 years and generate like 2.5 or 3% for the next 30 years. If you invest in stocks, you're going to get a lot more than that. So it brings you peace of mind, but you're going to leave a lot of money on the table right now. I don't think it's a good timing right now, but again, you can compare. You meet with a guy, he gives you a proposition, and you make the comparison with what you can reach with. And then if you invest in the stock market, aim maybe for a total return of 6, so you won't be disappointed. And then you can compare. But I'm pretty sure the annuity will offer you a returns of like 3%, maybe less than that. Soren, any comments on Algonquin that has been losing? Actually, the entire renewable energy sector. So renewable energy are not in the energy sector. They're in the utility sectors. Véronique, can you put the link on the YouTube video that I've done on that? The thing is, as interest rate goes higher, in 2020, there was that huge trend. So a lot of people invested in those stocks. So pretty much all of them, they skyrocketed. And keep in mind, they're utility stocks. They should go higher and higher very smoothly. So when everything skyrockets, sometimes it could go down. So now interest rates are going higher. So obviously, a lot of the market is worried about debt level and the fact that the future projects may not be as profitable as we thought. The other part is now that the energy sector is going higher and better and recovering, there's a lot of hype. So there's a lot of money going from renewable towards back to oil and gas. So there's a movement over there that is natural right now. So sector rotation. Now back to Algonquin. It's an amazing company. I have it in my portfolio. 65% of their business is regulated utilities. This means they have a monopoly. They deal with the regulator for rate increase and they make money all the time with that. 35% of their business is geared toward renewable, wind, solar. Great business. They do have an important stake in Atlantica Yield. The ticker is AY. They are in Europe, so that's a great place where you can diversify as well. We do cover Atlantica Yield because it's part of AQN on the side. This is a company that has been increasing its dividend for year after year. They have a great CapEx plan, so they're intent to invest a lot of money in the future. A lot of it will come actually from their own funds, which I like as well. So I'm definitely not worried. Is one of my favorite utility, and actually I benefited from the dip to add to my position. Sid, what do you think of Northland Power, NPI? I prefer Algonquin and Brookfield Renewable because they have shown a better perspective, stronger dividend triangle. So when you look at them, I would go with this one. Just bear with me a second. I'm going to take a look here. I just want to remember something, NPI. Yeah, dividend safety score of 2 because they don't increase their dividend. So for that reason, I would definitely prefer to go with Algonquin and Brookfield Renewable, BEP or BEPC for that reason. Lloyd, what do you mean by the triangle? Well, the triangle is more an image of a foundation. So it's like 3 metrics to create a triangle. So you have revenue growth, earnings growth, and dividend growth. We look at the trends of these 3 metrics, and this will help us. Like this is the first filter. This is the first layer of our search. So when we go for searching for great companies, or when we analyze a company, the first thing we'll do is make sure that the company is thriving, making money, and increasing their income, their dividend. Fabio, current thoughts on Algonquin Power, so that's done, and Canadian National Railway. Canadian National Railway and CP, Canadian Pacific, has been into a bidding war to acquire KSU, Kansas Southern Lines or something like that, railroads. Another railroad that has access to Mexico, and which is the biggest aspect of it. So they want to make sure they are able to go from Canada to the US to Mexico. Sounds like CNR may go through with this one. It will be very expensive, and this is why the stock price got down. What I like about that part is going forward, railroads are not going anywhere. They're going to stay here forever. So you pay a high price today for an asset, but in 10, 15, 20 years, that asset will continue to generate cash flow. So over the long run, it's not a concern. Over the short term, it's not a good deal. But down the road, I think it will make sense for them to do it. So they do it for the future. So that's why I will keep my shares of Canadian National Railways. Ravi, any comments on Magellan? I'm pretty sure MEL.to, right? They're doing stuff for satellites, if I remember correctly. Not a big fan. I'm just looking here. Yeah, so revenue and earnings are going down. It's not a company that we follow right now, so I don't have much information, but I remember that once I looked at it a few months ago, not a few months, but a few years ago, that didn't struck me as a company that has a lot of growth, especially in the aerospace business. When you look at other peers that are growing their revenue and growing their income, Magellan is doing the opposite, so it's definitely not a good thing. So yes, they have increased their dividend a few times, but I don't think it would have a place, especially if you compare to other aerospace companies. Not that many in Canada, I'll give you that, but I will go in the US instead. Mark, can you recommend an online stockbroker house to use? They're pretty much the same in my opinion. I use National Bank because I used to work there, and I also use Questrade as a small account. Both of them work well. It really depends, I'd say, on which type of investors you are. I like to keep things simple, so I have most of my accounts with National Bank because my bank account is there, so it's just easier to move money around. But today, it's not even the big thing, so you can look at companies, like look at the fees, and look if you have access to other research. Like National Bank offer Morningstars. You're going to have other companies that, like I've heard good things of BMO Investors Lines as well. Qtrade and Questrades are good for lower fees, but that's pretty much it. There's not necessarily like an outstanding company, and if you go for reviews on the web, on the web, you're going to find a lot of Questrade and Qtrade reviews because they pay affiliate fees. So that's the reason why they have more than others. Louis, what are your thoughts about having a financial planner? I had one for 20 years. As I will retire, his fees are 1% of portfolio, but represent a significant part of my income stream. It depends. Does he call you when the market crashes? Does he take care of you? And does he give you more advice about everything else than just your portfolio? Because if you're paying him 1% of your portfolio just for managing your portfolio, that's not worth it. You want to have advice. You want to have supports. You want to have estate planning, retirement planning. You want to make sure that this guy takes care of looking at your debt level, at your interest rate that you're paying, how you're going to redistribute your money once you pass away to your spouse or your children and grandchildren, maybe set up a trust and stuff like that. This is where you're going to get value from a financial planner. If he doesn't do that and he's working at investors and he's just charging you a fees for that, well, then then it's not necessarily worth it. But I've been a financial planner for 13 years. I don't know, can't remember. But my added value was not just about managing the funds. It was doing everything else that I just mentioned. And this is why clients were paying me a percentage on the portfolio. It's to all the other advice that you can give. And they are a very good one, but they are a very bad one as in the industry. Liz, some of us are in the process of breaking up with the banks and taking control of our own investment. Any chance of a coaching club for new members? We have private webinars. We have newsletters about that. In the forum, we can definitely have a channel that we're going to discuss those kind of strategies moving forward. So you can learn not only from me, but you can learn from other people that just did it. Our goal is really to give you all the tools, but all the financial knowledge as well to manage your portfolio. From time to time, I'll do private coaching as well, but that's another story. I don't do that many often. It's really more about how to learn how to fish, and between you and me, it's expensive. So that's another thing. You can send me an email. We can discuss later. But if you go at DSR, you'll learn a lot. We have videos as well, a lot of tutorial videos on how to manage your portfolio, make sure that everything is in an order. So we have a lot of support in that sense. So I think that if you are considering, we have a lot of members that considered breaking up with their banks at one point. They subscribe, they gain that confidence, they gain that conviction that they can do it, and they actually did it after that. So yes, we can do that. It's not one-on-one, it's not coaching, but you'll get the support you need. I've seen it with many members in the past. All right. Thank you so much for sticking with me. It's just amazing. So we're almost done with the questions. So I'm just going to try to be a little bit faster here. Fabio, what sector would you recommend to invest new money in order to possibly protect yourself from future inflation in the year or two? Go back to the presentation with the sectors about retirement. I think that's great. It's not necessarily about sectors if you want to protect your portfolio against inflation. It's about dividend growth. So use the dividend triangle. Use the ratings, make sure that you have growth there. And then for the sectors, you'll be able to find like the best of the breed for each sector, the best 2, 3, 4 stocks for each sector. You will have like a portfolio of like 30, 35 stocks that will do very well against inflation. And you don't need to go specifically on a sector, but if not, you can go back to the presentation. I've discussed those. Fabio, again, do you think banks may pay a special dividend to make up for the dividend suspension? I don't think so. I don't think so. The thing is, remember what happened in 2008, 2009? Between 2000 and 2010, National Bank increased their dividend for the first time, and then all the other banks followed, and the last one was BMO in 2012. Nobody paid a special dividend. They're greedy and conservative, so I'm pretty sure they're going to keep up their money because, I mean, paying out a special dividend will be just fun for shareholders. I wish they would, but I don't see why they would do it. They will just keep their cash, and that will be fine for everybody. Mark, thoughts on the industrial REITs category? Thanks. Amazing subsector. I love it. Granite, Stag are part of my favorite. This is where you're going to find a lot of growth as well. You have Dream Industrial, but what I don't like about Dream Industrial is that they don't increase their dividends. So I would go with definitely Granite and Stag. But yeah, this is a place where it's going to move forward. We need warehouses. We need high-tech facilities. So try to get like the high-class industrial REITs. But this category, obviously, it's not a secret. So it's been selected already. I think the best opportunities right now are in the apartment REITs, but industrial REITs and data centers are going to be great for going forward for sure. Mark, what about BTB? BTB is BTNB. BTB Real Estate. Can't remember this one. Sorry, this one. I'm just gonna skip it. Definitely not in my favorite if I can't remember it. So that's not a good sign. FCD. What is FCD? FCD. Firm Capital Property. I have not looked at it. I have received several requests on it at DSR recently. It's being added to our stock screener, but since it's on the TSX Venture, I have not looked at it yet. But it's on my to-do list because it has gained interest at DSR. Thanks, Michael. Keith, you're asking about what are my thoughts about Fiera Capital, FSZ. I really liked this company before the pandemic. They had like a great grow by acquisition strategy. They were growing their asset under management. They were doing well, and they were increasing their yield all the time. It has been more difficult after that. The thing with asset managers is that they're only good if they are able to convince institutional investors to invest with them. So have to keep track of their net inflows and net outflows. So and they have lost a lot of money last year for that. So the assets under management increased because the market recovered, but they lost some contracts with institutional investors, and the dividend is safe. The company is okay. It's not my favorite, but in terms of yield and the balance, not too bad. But if you want to look at a company that is doing well in that sort of field, I would rather pick Power Corporation, which is really a Lux bond. I don't expect the stock to continue skyrocket, but the dividend is good and they keep increasing it. So, and they went through the financial crisis a lot better, not the financial crisis, but the pandemic a lot better than Fiera. It's not a bad choice, but it's an okay stock. Harry, Mike, any thoughts and risk benefit on tapping into ELOC when larger dividend cuts are occurring, a temporary way out? So you mean to withdraw money from your home equity line of credit when you suffer from dividend cuts? Not necessarily the best idea if you just borrow more money and then you wait for those companies to recover. I think following your stocks better, making sure they increase their dividend instead of cutting them, looking at the payout ratio, and maybe using tools. I mean, it could be DSR, it could be another tool, but follow your portfolio quarterly. It's going to be a lot easier and better for you than trying to get debts. If you're thinking about doing leverage, you need at least 10 years in front of you. You need to be able to pay down that debt without the money that you borrow. And you need to be aware that you're going to go into a roller coaster ride, and that's fine. If you have those three things combined together, then borrowing from your ELOC to invest is a good thing. If not, I would not do it. I've done a lot of leverage loan when I was younger, and those are minimum requirements. So liquidity, being able to pay back the loan, high risk tolerance, super important, and long-term investment horizon. Soren, any ideas on Cargo Jet? Well, they have been the flavor of the month because of their overnight shipping carrier, but now it's a little bit harder to see if they will be able to continue moving forward. The need for overnight cargo will continue to happen, but at this point, I don't know how much the company can grow moving forward. They were definitely great benefit grid. They surfed on that trend. Not convinced it's going to happen for the rest of, like, it's going to continue to grow. Maybe the market will start to be disappointed at one point. Robert, when to select drip versus cash dividend? I prefer cash dividend. Both are great. If you want to put your portfolio on autopilot, you go with DRIP because they just buy the stocks that you like already. So that's great. I prefer to use cash because I like to use that cash to add to the position I want instead to rebalance my portfolio. So it's a little bit more active. So if you're the type of guy that will forget about the money in your account, go with a DRIP. If you're hands-on and you look at your portfolio quarterly and you do 2-3 transactions a year, as I mentioned earlier, that's what I do with my portfolio. Well, every time I do a transaction and I sell a stock, I sell the stock, I take the dividend, and I buy another position. And this is why I use it. Both works very well. Obviously, if you forget about the cash, it's not working for you. So that's probably bad. Jagdish, I currently own ETF in my RSP and TFSA. Should I sell them to buy dividend stocks? You know what? If you want to buy if you want to manage your portfolio, you need to have time to do it. You need minimum of knowledge, or you get access to a service that will give you that knowledge, and you need interest. If you're not interested in managing your portfolio, it's not going to work, right? I love my Jeep. I love driving it, taking off the rooftop and the doors. It's amazing. But when there's a light on the dashboard, I go to the dealership because I'll do more arms than good because I have no clue how to manage mechanic on a car. Having said that, if you're happy with the ETF and it works well for you, that's fine. If you think that you're missing out on something and you got interested into learning more about dividend growth investing, then you can do gradually. I have a lot of members that kept 40-50% of their portfolio as a core in ETF, and they had spices with dividend growth stocks. That's also a great idea where you can start. Sue, how many USA company stocks do you have? I didn't understand the 120 explanation. In terms of US stocks, I have about half of my portfolio. Right now, it's probably more 60% because I had like great success with some of my position. So 60% of US stocks, 40% Canada. If you are 100% Canadian right now, maybe you want to go with like 10-15% in US if you're old, like if you're over like 80. If not, you have maybe like 25 years in front of you. You can definitely go and add like 40-50% of your portfolio in US stocks. You'll get more diversification, better growth. Over time, the US stock market always outperformed the Canadian one. You know, it's impossible for us to find companies like Procter & Gamble, 3M, Lockheed Martin, Microsoft, Apple, BlackRock, Visa, those Starbucks, those companies don't exist in Canada. So you have this opportunity to have those exposure. Plus, it gives you international exposure because many of those businesses, they have like 50% of their revenue coming outside of North America. All right, Antonio, should we mix ETF and dividend stock strategy for retirement planning? I've already answered this one. So answer is yes, you can definitely have a core and mix both. Alex, what range do you consider as good for each of these criteria? Revenue growth, 5 years, earnings growth, and dividend growth. For the dividend triangle, I want to have a trend, and I want to have a minimum of growth, especially considering the pandemic. Sometimes even I will forgive actually a 1% or maybe a 5% decline of EPS over revenue for the past 5 years if I can see that there was a trend and then there's an explanation. So when you see a down in the trend over the past 5 years, if you can explain it and that makes sense, it's still it is still good. But in an ideal world, I look at positive return, positive growth for the three metrics. In the best case scenario, it will be like up 5 for each of them, but we all know that this will only happen after like towards the end of the bull market. So in 2017, it was easy to find those, but today, not so much. Max, any comments on holding Mike Genworth, which has been Saga or Sagina right now? The one I hold is not leverage, and it's mortgage. First mortgage only. I haven't dabbed into that much, so honestly, I don't have much information on this one. So sorry about that. Max. I cannot really answer your questions. Kind of starting to be very hard. I'm gonna keep going for maybe 2-3 more questions. It's been 2 hours and a half right now, so I'm starting to slow down a little bit. Charlie, what percentage of growth versus dividend growth investor would you recommend to my traditional Roth held by 75-year-old retirement? My apologies if you have already addressed this type. honestly, I would go with dividend growth investing, period, because you can find both growth and income at the same time. So that's the secret. So you can have like smaller one. It really depends. I think I'm going to stick to a 2-3% yield at retirement, because I rather have this balance between a few higher yielding, but a lot of low yield, high growth. But that's just me. If I want to keep it simple, then I will try to bring my portfolio yield at 4% and then sleep on it. Gilbert, what Canadian and US dividend growth ETF do you recommend? I use just benchmarks, so XDV and VIG. Those are the two ones that we use, xdv.to and VIG. So you can go on the DSR portfolio page. It's free. You see our returns and you'll see our benchmark. These are the only two that we use as benchmark, but we don't invest in the ETF, so I would not be the right one to do it. Dan, when is the best time to sell BPY? Pretty much now, because the dividend will not be paid anymore. It's going to be bought back. So I don't expect much fluctuation on this one. You may want till the end to get your full price, but if not, you can sell it now and move on. That's what we have done. We had it in our retirement portfolio back then, and that's what we did. Larry, thought on selling covered calls on your holdings like Apple and Microsoft? Not really, because I want to keep those and I don't want to be stuck buying back them. I know it creates more, it can create income, but in the meantime, it will also take some time that I don't necessarily have. So I'm not too keen on covered calls for that reason. It's, yes, you can generate more income, but then you need to be very good at it and make sure that you take care of the spreads between options to make sure that you select the right one, not get exercised too many times as well. So it's time consuming for the income it generates. But yes, it's a possibility. Jeff, if you buy high quality stocks and let them ride and then have the new money, so repeat, should you pick from stocks you already own or buy whatever seems the best without that limit? What if that cause would exceed 40 stocks? I would never exceed 40 stocks because I want my position to count. So if I have a great investment that doubles in value, but it was like 0.40% of my portfolio, that doesn't move the needle. I don't want that. So at one point, if you go overweight, if you pass your limit, you sell, and then you can reinvest that money towards companies within your portfolio. But I would definitely try to stay within 30 to 40 stocks. In an ideal world, they all move up at the same level or almost, so you don't have to sell that many times. For my personal position, it happens only with Apple. Never I had to sold other stocks than that, so that was still very good. Ari, what do I get with regular membership, the $97 a year? So what you get is access to our portfolio models. We have the stock screener going through about 1,000 dividend stocks, US and Canadian. We cover about 400 stock analysis inside that. So the best stocks are there. The bad stocks are not analyzed, but you get all the metrics nonetheless. So you just don't have our investment thesis. You get access to the private webinars, the weekly newsletters. So basically everything that is not about portfolio management, you get access to it. And if you want at one point and you love it, you can upgrade to Dsr Pro later on. Obviously the price will increase next week, but you'll have the ability to improve your, upgrade your membership at any time. Sue, what do you think about IBM? I don't like it. From all the tech stocks that you can find that pays dividend, you can find easily 10 companies that do better than IBM. So I don't know why I would select the only company that managed to post almost 5 years of consecutive quarters declining revenue. That's crazy. Like it was like 22 or something, 22 quarters that were continually declining. So yes, they have a good business with the cloud, but it's not growing fast enough to compensate for the bad business that is slowly dying. So you're leaving a lot of money on the table by looking at IBM versus the others. I know that the yield is good, but that's pretty much the only thing. And you know what? The yield is good is not a good investing reason. What about Calian Technology from S? I haven't followed this one much because it doesn't increase its dividends, so I don't have much thoughts to put into it. Sorry about this one. Jay, you're asking about Air Canada. Then again, doesn't pay dividend. Speculative play at best. If you want to play casino, you can do it. I'm not doing that. Last two. Bob, you mentioned 3, maybe 4 trades a year, but then check your portfolio quarterly. Does DSR share sell recommendations? Yes, we actually, if you have your portfolio pro report, you're going to have in the pro ratings, we are like rating 1s and 2s are sell recommendation. We're just saying we don't like those stocks. You should look into it deeply. So then every quarter, if there's anything that happens that we don't like, the rating will change. The explanation will come in your report at the same time. So it's pretty easy because we will highlight those stocks in your report. So we'll tell you, oh, we don't like IBM. We don't like this one. We don't like this one. And then here are the replacements that you can look at. We have a list because we don't give buy or sell recommendation, obviously, but at least it points you towards the right direction, makes your life easier, and enable you to invest with more conviction and say, you know what, I'm stuck. I'm done waiting. I'm going to go with this one. I'm going to sell, and then I'm going to move on. All right. So thank you so much for being there. You're like a patient crowd. That has been crazy. I had a lot of fun. I hope that I've answered all your questions and I've given you a ton of value today. If you have enjoyed that, I do that monthly, actually 10 times a year, private webinars, DSR members only. That's amazing because no sales pitch. We just dive in. We use the platform for better lending. We answer everything because I got the question in advance. So that's even amazing. So thank you for being there. Max, Jeff, Lawrence, Jay, Liz, Rod, Pavan. It has been fun. Go check out DSR if you're looking for a hiking buddy that will help you in your investment journey. If you don't like it, 60 days money back guarantee. It's pretty much the only risk-free investment you can do. And thank you very much for your time. And until the next webinar, stay invested. Cheers, guys. Thank you.